1. Introduction to oil investing. 1.1 Understanding the basics of oil. Before diving into the world of oil investing, it is crucial to have a solid understanding of the basics of oil. Oil, also known as petroleum, is a naturally occurring fossil fuel that is formed from the remains of ancient plants and animals. It is found deep beneath the Earth's surface and is extracted through drilling and extraction processes. What is oil used for? Oil plays a vital role in our daily lives and is used in various sectors, including transportation, manufacturing, and energy production. Here are some of the primary uses of oil. Transportation. Oil is a key component in the production of gasoline, diesel, and jet fuel, which power vehicles, airplanes, and ships. Manufacturing. Oil is used in the production of plastics, synthetic fibers, lubricants, and chemicals, making it an essential raw material for various industries. Energy production. Oil is burned to generate electricity in power plants, providing energy for homes, businesses, and industries. Heating and cooking. Oil is used as a fuel for heating homes and buildings, as well as for cooking in many households. Global oil production and consumption. Oil is a finite resource, and its availability and production are influenced by various factors. The largest oil-producing countries include the United States, Saudi Arabia, Russia, and Canada. These countries have significant reserves and infrastructure to extract and refine oil. On the other hand, oil consumption is driven by global demand, which is influenced by economic growth, population growth, and industrial development. The largest consumers of oil are the United States, China, India, and Japan. Types of oil. There are different types of oil, each with its own characteristics and uses. The two main types of oil are crude oil. Crude oil is the unrefined form of oil that is extracted from the ground. It is a mixture of hydrocarbons and other organic compounds. Crude oil is further classified based on its density and sulfur content, with light sweet crude being the most desirable due to its low density and sulfur content. Refined oil products. Crude oil is refined to produce various petroleum products, including gasoline, diesel, jet fuel, heating oil, and lubricants. These refined products have different properties and are used for specific purposes. Oil prices. Oil prices are determined by various factors, including supply and demand dynamics, geopolitical events, economic conditions, and market speculation. The price of oil is typically quoted in US dollars per barrel and is influenced by global oil benchmarks such as Brent crude and West Texas Intermediate (WTI). Investors in the oil market closely monitor oil prices as they have a significant impact on the profitability of oil investments. Understanding the factors that affect oil prices is crucial for successful oil investing. Conclusion. Having a solid understanding of the basics of oil is essential before venturing into oil investing. Oil is a vital resource used in transportation, manufacturing, and energy production. It is a finite resource with different types and is subject to various factors that influence its production, consumption, and price. In the next section, we will explore the reasons why investing in oil can be a lucrative opportunity for investors. 1.2 Why invest in oil? Investing in oil can be a lucrative opportunity for investors looking to diversify their portfolios and potentially earn significant returns. Oil is a vital global commodity that plays a crucial role in various industries, including transportation, manufacturing, and energy production. Here are several reasons why investing in oil can be a smart financial decision. 1. High demand and global significance. Oil is one of the most widely used energy sources worldwide, and its demand continues to grow steadily. As emerging economies expand and populations increase, the need for oil is expected to rise even further. This high demand ensures a stable market for oil investments, making it an attractive option for investors. 2. Limited supply and finite resource. Oil is a finite resource, and its supply is limited. As oil reserves are depleted, it becomes increasingly challenging and expensive to extract oil from the ground. This scarcity factor can drive up the price of oil, making it a valuable investment. Additionally, geopolitical tensions and conflicts in oil-producing regions can disrupt the supply chain, further impacting oil prices. 3. Inflation hedge. Oil has historically been considered an effective hedge against inflation. When inflation rises, the value of currencies tends to decline, but the price of oil typically increases. As a result, investing in oil can help protect your portfolio from the negative effects of inflation and preserve your purchasing power. 4. Diversification benefits. Including oil investments in your portfolio can provide diversification benefits. Oil prices often move independently of other asset classes, such as stocks and bonds. This means that when other investments may be experiencing volatility or downturns, oil investments can potentially perform well, helping to offset losses and stabilize your overall portfolio. 5. Potential for high returns. Investing in oil can offer the potential for significant returns. As oil prices fluctuate, investors who can accurately predict and capitalize on these price movements can generate substantial profits. However, it's important to note that investing in oil also carries risks, and careful analysis and research are necessary to make informed investment decisions. 6. Income generation. Investing in oil can provide income generation opportunities through dividends and distributions. Many oil companies pay dividends to their shareholders, allowing investors to earn regular income from their investments. Additionally, certain oil investment vehicles, such as oil-focused mutual funds or exchange-traded funds (ETFs), may distribute income to investors based on the performance of the underlying assets. 7. Technological advancements. Technological advancements in the oil industry have significantly improved the efficiency and cost-effectiveness of oil extraction and production. Innovations such as hydraulic fracturing, fracking, and horizontal drilling have unlocked previously inaccessible oil reserves, expanding the potential for profitable investments. Staying informed about these advancements can help investors identify opportunities and make informed investment decisions. 8. Portfolio protection. Oil investments can act as a hedge against geopolitical risks and market uncertainties. Geopolitical events, such as conflicts or disruptions in oil-producing regions, can cause oil prices to spike. By including oil investments in your portfolio, you can potentially offset losses in other areas of your portfolio during times of market volatility or geopolitical instability. 9. Energy transition opportunities. While the world is gradually transitioning towards renewable energy sources, oil will continue to play a significant role in the global energy mix for the foreseeable future. Investing in oil allows investors to participate in the ongoing energy transition while still benefiting from the demand for oil. This can provide a balanced approach to investing in both traditional and renewable energy sectors. 10. Portfolio liquidity. Oil investments offer relatively high liquidity compared to other alternative investments. Oil futures and ETFs, for example, can be easily bought and sold on major exchanges, providing investors with the flexibility to enter or exit positions quickly. This liquidity allows investors to react swiftly to market conditions and adjust their investment strategies accordingly. In conclusion, investing in oil can offer numerous advantages, including high demand, limited supply, inflation hedging, diversification benefits, potential for high returns, income generation, technological advancements, portfolio protection, energy transition opportunities, and portfolio liquidity. However, it's crucial to conduct thorough research, stay informed about market trends, and carefully assess the risks associated with oil investments before making any investment decisions. 1.3 Factors affecting oil prices. Understanding the factors that influence oil prices is crucial for successful oil investing. Oil prices are determined by a complex interplay of various factors, including supply and demand dynamics, geopolitical events, economic indicators, and market sentiment. In this section, we will explore some of the key factors that can impact oil prices. 1. Global supply and demand. The fundamental principle of supply and demand plays a significant role in determining oil prices. When global demand for oil exceeds supply, prices tend to rise, and when supply exceeds demand, prices tend to fall. Several factors can affect the supply and demand dynamics of oil. Economic growth. Economic growth is a major driver of oil demand. As economies expand, the demand for oil increases, particularly in sectors such as transportation, manufacturing, and construction. Conversely, during periods of economic downturn, oil demand tends to decline. Production levels. The production decisions made by major oil-producing countries, such as OPEC, Organization of the Petroleum Exporting Countries, and non-OPEC nations, can significantly impact global oil supply. Production cuts or increases by these countries can influence oil prices. Inventories. The level of oil inventories held by countries and organizations can affect prices. High inventory levels indicate an oversupply, which can put downward pressure on prices. Conversely, low inventory levels can lead to price increases due to concerns about potential supply shortages. 2. Geopolitical events. Geopolitical events have the potential to disrupt oil supply and create volatility in oil markets. Political instability, conflicts, sanctions, and geopolitical tensions in major oil-producing regions can impact oil prices. Some examples of geopolitical events that have affected oil prices in the past include Middle East unrest. The Middle East is a significant oil-producing region, and any disruptions in this area can have a significant impact on global oil supply. Political conflicts, civil unrest, and regional tensions can lead to supply disruptions and price spikes. Sanctions. The imposition of sanctions on oil-producing countries can restrict their ability to export oil, leading to reduced supply and higher prices. For example, sanctions on Iran have had a notable impact on global oil markets in the past. Natural disasters. Natural disasters, such as hurricanes or earthquakes, can disrupt oil production and transportation infrastructure, leading to supply disruptions and price volatility. 3. Economic indicators. Economic indicators provide insights into the overall health of the global economy and can influence oil prices. Some key economic indicators to monitor include GDP growth. The growth rate of the global economy, as measured by gross domestic product (GDP), can impact oil demand. Higher GDP growth rates generally correspond to increased oil consumption and higher prices. Interest rates. Monetary policy decisions, such as changes in interest rates by central banks, can impact economic growth and, consequently, oil demand. Lower interest rates can stimulate economic activity and increase oil consumption. Currency exchange rates. Oil is priced in US dollars, so fluctuations in currency exchange rates can affect the purchasing power of oil importing countries. A stronger US dollar can make oil more expensive for countries using other currencies, potentially reducing demand. 4. Market sentiment and speculation. Market sentiment and speculation can also influence oil prices. Investor perceptions, expectations, and sentiment about future oil supply and demand can lead to price fluctuations. Speculative trading in oil futures markets can amplify price movements, particularly in the short term. Investor sentiment. Positive or negative sentiment towards the oil market can impact prices. Factors such as economic outlook, geopolitical developments, and market expectations can shape investor sentiment. Speculative trading. Speculators, including hedge funds and other financial institutions, can engage in trading activities that aim to profit from short-term price movements. Their actions can contribute to increased volatility in oil markets. It is important to note that oil prices are highly volatile and can be influenced by a combination of these factors. Additionally, the interplay between these factors is complex and can change rapidly. As an oil investor, staying informed about these factors and regularly monitoring market developments is essential for making informed investment decisions. To invest in oil, there are several options available to individuals. Here are some common ways to invest in oil. Oil stocks. Investing in oil company stocks is one of the most popular ways to gain exposure to the oil industry. This involves buying shares of publicly traded oil companies, such as ExxonMobil or Chevron. When investing in oil stocks, it is important to research and analyze the financial health, management, and future prospects of the company before making any investment decisions. Oil ETFs. Exchange-traded funds (ETFs) are investment funds that trade on stock exchanges, similar to individual stocks. Oil ETFs allow investors to gain exposure to the oil industry without directly investing in individual oil companies. These funds typically hold a portfolio of oil-related assets, such as stocks of oil companies, futures contracts, or oil-related derivatives. Oil futures and options. Futures and options contracts are financial instruments that allow investors to speculate on the future price of oil. Futures contracts obligate the buyer to purchase a specified quantity of oil at a predetermined price and date in the future, while options contracts give the buyer the right, but not the obligation, to buy or sell oil at a specific price within a certain time frame. Trading oil futures and options requires a good understanding of the market and can be more complex and risky compared to other investment options. Oil mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of securities, including oil-related assets. Oil mutual funds are managed by professional fund managers who make investment decisions on behalf of the investors. These funds can provide exposure to a broad range of oil-related investments, such as oil stocks, ETFs, and futures contracts. Direct investment in oil wells. For more experienced and sophisticated investors, direct investment in oil wells or oil drilling projects is an option. This involves investing directly in oil exploration and production companies or participating in limited partnerships or joint ventures that focus on oil drilling activities. Direct investment in oil wells can offer the potential for high returns but also carries significant risks, including the possibility of dry wells or operational challenges. Before investing in oil, it is important to consider the risks and rewards associated with this asset class. Here are some key factors to consider. Risks of oil investing. Price volatility. Oil prices are highly volatile and can be influenced by various factors, including geopolitical events, supply and demand dynamics, and economic conditions. Sudden price fluctuations can impact the value of oil investments. Geopolitical risks. The oil industry is susceptible to geopolitical risks, such as conflicts, sanctions, and political instability in oil-producing regions. These risks can disrupt oil supply and impact prices. Environmental concerns. The oil industry faces increasing scrutiny and regulation due to environmental concerns, including climate change and pollution. Changes in environmental policies and regulations can impact the profitability and operations of oil companies. Technological disruptions. Advancements in renewable energy technologies and alternative fuels pose a long-term risk to the demand for oil. As the world transitions towards cleaner energy sources, the demand for oil may decline, affecting the profitability of oil investments. Rewards of oil investing. Potential for high returns. Oil investments have the potential to generate significant returns, especially during periods of high oil prices. Successful investments in oil stocks or oil drilling projects can result in substantial profits. Diversification benefits. Adding oil investments to a diversified portfolio can help reduce overall portfolio risk. Oil prices often move independently of other asset classes, such as stocks and bonds, providing diversification benefits. Income generation. Some oil investments, such as dividend-paying oil stocks or oil-focused mutual funds, can provide regular income in the form of dividends or distributions. Inflation hedge. Historically, oil has been considered an inflation hedge, as rising inflation tends to drive up oil prices. Investing in oil can help protect against the erosion of purchasing power caused by inflation. It is important to note that investing in oil carries risks, and investors should carefully assess their risk tolerance, investment goals, and time horizon before allocating a portion of their portfolio to oil investments. Consulting with a financial advisor or investment professional can provide valuable guidance and help tailor an investment strategy that aligns with individual needs and objectives. 2. Types of oil investments. 2.1 Investing in oil stocks. Investing in oil stocks is one of the most common ways for individuals to gain exposure to the oil industry. Oil stocks represent ownership in companies that are involved in various aspects of the oil sector, including exploration, production, refining, and marketing. This section will provide you with a comprehensive guide on how to invest in oil stocks effectively. Understanding oil stocks. Before diving into the world of oil stocks, it is essential to have a basic understanding of how they work. Oil stocks are shares of publicly traded companies that operate in the oil industry. These companies can be classified into three main categories: upstream, midstream, and downstream. Upstream companies. These companies are involved in the exploration and production of oil and gas reserves. They search for new oil fields, drill wells, and extract oil and gas from the ground. Midstream companies. Midstream companies are responsible for transporting and storing oil and gas. They operate pipelines, storage facilities, and terminals to ensure the smooth flow of oil and gas from the production sites to refineries and end consumers. Downstream companies. Downstream companies are involved in the refining, processing, and marketing of oil and gas products. They convert crude oil into refined products such as gasoline, diesel, and jet fuel, and distribute them to consumers through various channels. Benefits of investing in oil stocks. Investing in oil stocks can offer several benefits to investors. Here are some key advantages. Potential for capital appreciation. Oil stocks have the potential to generate significant capital appreciation if the price of oil rises. As the demand for oil increases, the value of oil stocks can also increase, leading to potential profits for investors. Dividend income. Many oil companies pay dividends to their shareholders. Dividends are a portion of the company's profits distributed to shareholders on a regular basis. Investing in oil stocks that offer dividends can provide a steady income stream for investors. Portfolio diversification. Including oil stocks in your investment portfolio can help diversify your holdings. Oil stocks often have a low correlation with other asset classes, such as stocks and bonds, which can help reduce overall portfolio risk. Inflation hedge. Oil stocks have historically acted as a hedge against inflation. When inflation rises, the price of oil tends to increase, which can benefit oil companies and their shareholders. How to invest in oil stocks. Now that you understand the basics of oil stocks and their benefits, let's explore the steps to invest in oil stocks. Research and analysis. Start by conducting thorough research on oil companies. Look for companies with strong financials, a proven track record, and a competitive advantage in the industry. Analyze their balance sheets, income statements, and cash flow statements to assess their financial health. Choose the right brokerage account. To invest in oil stocks, you'll need to open a brokerage account. Select a reputable brokerage firm that offers a wide range of investment options, competitive fees, and user-friendly trading platforms. Determine your investment strategy. Decide whether you want to invest in individual oil stocks or exchange-traded funds, ETFs, that track the performance of the oil industry as a whole. Individual stocks offer the potential for higher returns but also come with higher risks. ETFs provide diversification and are suitable for investors seeking broader exposure to the oil sector. Set a budget. Determine how much you are willing to invest in oil stocks. It is crucial to set a budget that aligns with your financial goals and risk tolerance. Avoid investing more than you can afford to lose. Place your orders. Once you have chosen the oil stocks or ETFs you want to invest in, place your buy orders through your brokerage account. You can choose to invest a lump sum or set up a systematic investment plan to invest a fixed amount regularly. Monitor and review. Regularly monitor the performance of your oil investments and stay updated on industry news and trends. Review your investment strategy periodically and make adjustments if necessary. Risks of investing in oil stocks. While investing in oil stocks can be rewarding, it is essential to be aware of the risks involved. Some key risks include volatility. Oil prices can be highly volatile, which can impact the profitability of oil companies and the value of their stocks. Geopolitical risks. Political instability, conflicts, and regulatory changes in oil-producing regions can significantly affect oil prices and the operations of oil companies. Environmental concerns. Increasing environmental regulations and the shift towards renewable energy sources pose long-term risks to the oil industry. Company-specific risks. Each oil company has its own set of risks, such as operational challenges, debt levels, and management issues. It is crucial to assess these risks before investing. In conclusion, investing in oil stocks can be a lucrative opportunity for investors looking to gain exposure to the oil industry. By understanding the basics of oil stocks, conducting thorough research, and managing risks effectively, you can make informed investment decisions and potentially benefit from the growth and profitability of the oil sector. 2.2 Investing in oil ETFs. Investing in oil can be a lucrative opportunity for investors looking to diversify their portfolios and take advantage of the potential returns offered by the energy sector. While investing directly in oil stocks or futures may require a higher level of expertise and risk tolerance, there are alternative investment vehicles available, such as oil exchange-traded funds (ETFs), that provide a more accessible and convenient way to gain exposure to the oil market. What are oil ETFs? Oil ETFs are investment funds that are traded on stock exchanges, just like individual stocks. These funds are designed to track the performance of oil-related assets, such as oil futures contracts, oil company stocks, or oil-related indexes. By investing in an oil ETF, investors can gain exposure to the price movements of oil without directly owning physical barrels of oil or engaging in complex futures trading. Benefits of investing in oil ETFs. Diversification. Oil ETFs typically hold a diversified portfolio of oil-related assets, which helps spread the investment risk across multiple companies or commodities. This diversification can help reduce the impact of any single company's performance or the volatility of a specific oil contract. Liquidity. Oil ETFs are traded on major stock exchanges, providing investors with the ability to buy or sell shares throughout the trading day at market prices. This liquidity makes it easier for investors to enter or exit their positions without the need for complex transactions. Cost efficiency. Investing in oil ETFs can be a cost-effective way to gain exposure to the oil market. Compared to investing in individual oil stocks or futures contracts, oil ETFs often have lower expense ratios and transaction costs. Accessibility. Oil ETFs can be purchased through brokerage accounts, making them accessible to a wide range of investors. Whether you are an individual investor or a large institutional investor, you can easily buy or sell oil ETF shares through your preferred brokerage platform. Transparency. Oil ETFs disclose their holdings on a regular basis, allowing investors to see the underlying assets and their respective weights in the fund. This transparency enables investors to make informed decisions based on the composition of the ETF and its alignment with their investment objectives. Types of oil ETFs. There are different types of oil ETFs available in the market, each with its own investment strategy and focus. Here are some common types of oil ETFs. Crude oil ETFs. These ETFs track the price movements of crude oil by investing in oil futures contracts. They aim to replicate the performance of a specific crude oil benchmark, such as West Texas Intermediate (WTI) or Brent crude. Oil company ETFs. These ETFs invest in stocks of oil exploration, production, refining, or marketing companies. They provide exposure to the performance of oil-related companies rather than the direct price movements of oil. Oil services ETFs. These ETFs focus on companies that provide services to the oil industry, such as drilling, equipment manufacturing, or oilfield services. They offer exposure to the performance of the oilfield services sector. Energy sector ETFs. While not exclusively focused on oil, these ETFs invest in a broader range of energy-related companies, including oil, natural gas, and renewable energy companies. They provide exposure to the overall energy sector. Factors to consider. Before investing in oil ETFs, it is important to consider the following factors. Investment objective. Determine your investment objective and risk tolerance. Are you looking for short-term price speculation or long-term exposure to the oil market? Understanding your investment goals will help you choose the most suitable oil ETF. Expense ratio. Compare the expense ratios of different oil ETFs. Lower expense ratios can have a positive impact on your overall investment returns over the long term. Tracking error. Assess the historical tracking error of the ETF. Tracking error measures the deviation of the ETF's performance from its underlying index or benchmark. Lower tracking error indicates better replication of the desired investment exposure. Liquidity and trading volume. Consider the liquidity and trading volume of the ETF. Higher liquidity and trading volume can result in tighter bid-ask spreads and better execution of trades. Fund size. Evaluate the size of the ETF. Larger funds may have more efficient operations and lower trading costs. Fund holdings. Review the holdings of the ETF to ensure they align with your investment strategy. Understand the composition of the fund and the weightings of different assets or companies. Conclusion. Investing in oil ETFs can be an effective way to gain exposure to the oil market without the complexities and risks associated with direct oil investments. These funds offer diversification, liquidity, and cost efficiency, making them accessible to a wide range of investors. However, it is important to carefully consider your investment objectives, evaluate the different types of oil ETFs available, and assess factors such as expense ratios, tracking error, liquidity, and fund holdings before making investment decisions. By doing so, you can make informed choices and potentially benefit from the opportunities presented by the oil market. 2.3 Investing in oil futures and options. Investing in oil futures and options is a popular strategy for those looking to gain exposure to the oil market. Futures and options contracts allow investors to speculate on the future price of oil without actually owning the physical commodity. This section will provide an overview of how to invest in oil futures and options, including the benefits and risks associated with these investment vehicles. Understanding oil futures. Oil futures are contracts that obligate the buyer to purchase a specified quantity of oil at a predetermined price and date in the future. These contracts are traded on commodity exchanges, such as the New York Mercantile Exchange (NYMEX) and the Intercontinental Exchange (ICE). Investing in oil futures can be done through a brokerage account that offers access to these exchanges. One of the main advantages of investing in oil futures is the ability to profit from both rising and falling oil prices. If an investor believes that oil prices will increase, they can buy a futures contract at the current price and sell it at a higher price in the future, thus making a profit. Conversely, if an investor believes that oil prices will decrease, they can sell a futures contract at the current price and buy it back at a lower price, again making a profit. Benefits of investing in oil futures. Leverage. Oil futures allow investors to control a large amount of oil with a relatively small investment. This leverage can amplify potential gains, but it also increases the risk of losses. Liquidity. The oil futures market is highly liquid, meaning that there are always buyers and sellers available. This ensures that investors can enter and exit positions easily without significant price impact. Price discovery. The futures market provides valuable price information that reflects market sentiment and expectations. This information can be used by investors to make informed decisions about their oil investments. Portfolio diversification. Investing in oil futures can provide diversification benefits to a portfolio. Oil prices often move independently of other asset classes, such as stocks and bonds, which can help reduce overall portfolio risk. Risks of investing in oil futures. Price volatility. Oil prices can be highly volatile, influenced by factors such as geopolitical events, supply and demand dynamics, and economic conditions. This volatility can lead to significant price swings in oil futures contracts, resulting in potential losses for investors. Leverage risk. While leverage can amplify gains, it also magnifies losses. If the price of oil moves against an investor's position, they may be required to deposit additional funds to maintain their position or face forced liquidation. Timing risk. Predicting the direction and timing of oil price movements is challenging. Investors in oil futures need to accurately forecast market trends to profit from their positions. Incorrect timing can result in losses or missed opportunities. Market risk. The oil futures market is influenced by various external factors, including global economic conditions, political events, and regulatory changes. These factors can impact the supply and demand dynamics of oil, affecting its price and the performance of oil futures contracts. Understanding oil options. Oil options are derivative contracts that give the holder the right, but not the obligation, to buy or sell a specified quantity of oil at a predetermined price, strike price, within a specific time period. Options provide investors with the opportunity to profit from price movements in oil while limiting their downside risk. There are two types of oil options: call options and put options. A call option gives the holder the right to buy oil at the strike price, while a put option gives the holder the right to sell oil at the strike price. Investors can buy or sell options contracts through a brokerage account that offers options trading. Benefits of investing in oil options. Limited risk. Unlike futures contracts, options limit the investor's risk to the premium paid for the option. This means that investors can participate in the potential upside of oil price movements while knowing their maximum potential loss upfront. Flexibility. Options provide investors with the flexibility to choose their desired level of exposure to the oil market. They can buy or sell options with different strike prices and expiration dates, allowing for customized investment strategies. Hedging. Oil options can be used as a hedging tool to protect against adverse price movements. For example, an oil producer can buy put options to hedge against a potential decline in oil prices, ensuring a minimum selling price for their production. Risks of investing in oil options. Time decay. Options have a limited lifespan, and their value erodes over time. This time decay, known as theta, can erode the value of an option even if the underlying oil price remains unchanged. Investors need to be mindful of this when trading options. Volatility risk. Options prices are influenced by market volatility. Higher volatility generally leads to higher option prices, while lower volatility can result in lower option prices. Investors need to consider the volatility of the oil market when trading options. Limited profit potential. While options limit the investor's downside risk, they also limit the potential for significant gains. The profit potential of an option is capped at the difference between the strike price and the market price of the underlying oil. Complexity. Options trading can be complex, especially for inexperienced investors. Understanding the various option strategies, including spreads and combinations, requires knowledge and experience. It is essential to educate oneself or seek professional advice before engaging in options trading. Investing in oil futures and options can be a lucrative strategy for those who understand the risks involved and have a solid understanding of the oil market. It is crucial to conduct thorough research, stay informed about market developments, and consider working with a knowledgeable broker or financial advisor to navigate the complexities of these investment vehicles. 2.4 Investing in oil mutual funds. Investing in oil can be a lucrative opportunity for investors looking to diversify their portfolios and potentially earn significant returns. While there are various ways to invest in oil, one popular option is through oil mutual funds. Oil mutual funds provide investors with the opportunity to gain exposure to the oil industry without the need for direct ownership of oil assets. In this section, we will explore the benefits, risks, and considerations associated with investing in oil mutual funds. Understanding oil mutual funds. Oil mutual funds are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of oil-related assets. These funds are managed by professional fund managers who make investment decisions on behalf of the investors. The portfolio of an oil mutual fund typically includes stocks of oil companies, oil futures contracts, and other oil-related securities. Benefits of investing in oil mutual funds. Diversification. Oil mutual funds provide investors with a diversified exposure to the oil industry. By investing in a mutual fund, investors gain access to a wide range of oil-related assets, reducing the risk associated with investing in a single company or asset. Professional management. Oil mutual funds are managed by experienced professionals who have in-depth knowledge of the oil industry. These fund managers conduct thorough research and analysis to make informed investment decisions, potentially maximizing returns for investors. Liquidity. Investing in oil mutual funds offers investors the advantage of liquidity. Unlike direct investments in oil assets, mutual funds can be bought or sold on any business day at the fund's net asset value (NAV). This provides investors with the flexibility to enter or exit their positions as per their investment goals. Lower minimum investment. Oil mutual funds typically have lower minimum investment requirements compared to direct investments in oil assets. This makes them accessible to a wider range of investors, including those with limited capital. Risk mitigation. Investing in oil mutual funds can help mitigate the risk associated with investing in the volatile oil market. The diversification provided by these funds helps spread the risk across multiple assets, reducing the impact of any single investment on the overall portfolio. Risks and considerations. Market volatility. The oil market is known for its volatility, and this can impact the performance of oil mutual funds. Fluctuations in oil prices can lead to significant swings in the value of the fund. Investors should be prepared for potential short-term losses and have a long-term investment horizon. Management risk. The performance of an oil mutual fund is heavily dependent on the skills and expertise of the fund manager. Poor investment decisions or a lack of understanding of the oil market can negatively impact the fund's returns. It is essential to research and choose a fund with a proven track record and experienced management team. Fees and expenses. Like any investment vehicle, oil mutual funds charge fees and expenses for managing the fund. These fees can include management fees, administrative expenses, and sales loads. Investors should carefully review the fee structure of the fund and consider the impact on their overall returns. Market and regulatory risks. The oil industry is subject to various market and regulatory risks. Changes in government policies, geopolitical tensions, and environmental regulations can impact the performance of oil mutual funds. Investors should stay informed about industry trends and developments to make informed investment decisions. Choosing an oil mutual fund. When selecting an oil mutual fund, investors should consider the following factors. Performance. Evaluate the historical performance of the fund over different market cycles. Look for consistent returns and compare the fund's performance to its benchmark index and peers. Fund objectives. Understand the investment objectives of the fund. Some funds may focus on specific segments of the oil industry, such as exploration and production, refining and marketing, or oilfield services. Choose a fund that aligns with your investment goals and risk tolerance. Fund size and assets under management (AUM). Consider the size of the fund and its AUM. Larger funds may have more resources and better access to investment opportunities. However, smaller funds may offer more flexibility and potential for higher returns. Expense ratio. Compare the expense ratios of different funds. Lower expense ratios can have a positive impact on long-term returns. Fund manager. Research the fund manager's experience, track record, and investment philosophy. A skilled and experienced fund manager can significantly impact the fund's performance. Risk management. Evaluate the fund's risk management strategies and the steps taken to mitigate potential risks. Look for funds that have a disciplined approach to risk management. Conclusion. Investing in oil mutual funds can be an effective way to gain exposure to the oil industry without the need for direct ownership of oil assets. These funds offer diversification, professional management, and liquidity, making them an attractive option for investors. However, it is essential to carefully consider the risks and choose a fund that aligns with your investment goals and risk tolerance. By conducting thorough research and due diligence, investors can make informed decisions and potentially benefit from the long-term growth and profitability of the oil industry. To invest in oil, there are several options available to you. Here are some common ways to invest in oil. Investing in oil stocks. One of the most popular ways to invest in oil is by purchasing stocks of oil companies. This allows you to indirectly invest in the oil industry and benefit from the performance of these companies. When considering oil stocks, it is important to research and analyze the financial health, management, and growth potential of the companies you are interested in. Investing in oil ETFs. Exchange-traded funds (ETFs) are investment funds that trade on stock exchanges. Oil ETFs are designed to track the performance of oil-related assets, such as oil company stocks or oil futures contracts. Investing in oil ETFs provides diversification and allows you to gain exposure to the oil industry without directly investing in individual stocks. Investing in oil futures and options. Futures and options contracts allow investors to speculate on the future price of oil. These derivative instruments can be highly volatile and require a good understanding of the oil market. Investing in oil futures and options can be risky, but it also offers the potential for significant returns. Investing in oil mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of oil-related assets. Oil mutual funds can invest in a variety of oil-related securities, including stocks, bonds, and derivatives. Investing in oil mutual funds provides professional management and diversification, making it a suitable option for investors looking for a more hands-off approach. Before investing in oil, it is important to conduct thorough research and analysis. Here are some key factors to consider when analyzing oil companies. Financial analysis of oil companies. Financial analysis plays a crucial role in evaluating the financial health and performance of oil companies. Here are some key financial metrics to consider. Revenue and profitability. Analyze the company's revenue growth over time and compare it to its competitors. Look at the company's profitability ratios, such as gross profit margin, operating profit margin, and net profit margin, to assess its ability to generate profits. Debt levels. Evaluate the company's debt levels and its ability to manage its debt obligations. Look at the debt-to-equity ratio and interest coverage ratio to determine the company's financial leverage and its ability to service its debt. Cash flow. Examine the company's cash flow from operations, investing activities, and financing activities. Positive cash flow is essential for the company's operations and growth. Pay attention to the company's ability to generate free cash flow, which can be used for dividends, debt repayment, or reinvestment in the business. Return on investment. Assess the company's return on investment (ROI) and return on equity (ROE) to determine its profitability and efficiency in generating returns for shareholders. Dividend history. If the company pays dividends, analyze its dividend history, dividend yield, and dividend payout ratio. A consistent and growing dividend can be a sign of a financially stable and shareholder-friendly company. Financial ratios. Calculate and analyze various financial ratios, such as price-to-earnings ratio (PE), price-to-sales ratio (PS), and price-to-book ratio (PB). These ratios can help you assess the company's valuation and compare it to its peers. It is important to note that financial analysis should not be the sole basis for investment decisions. It should be combined with other factors, such as industry trends, competitive analysis, and macroeconomic factors, to make informed investment decisions. By conducting a comprehensive financial analysis of oil companies, you can gain insights into their financial health, profitability, and growth potential. This analysis will help you make informed investment decisions and increase your chances of success in the oil investing market. 3.2 Evaluating oil reserves. When it comes to investing in oil, one of the key factors to consider is the evaluation of oil reserves. Oil reserves refer to the estimated amount of oil that can be commercially extracted from a particular oil field or region. This evaluation is crucial as it helps investors determine the potential profitability and longevity of an oil investment. Understanding oil reserves. Oil reserves are typically categorized into three main types: proven reserves, probable reserves, and possible reserves. Proven reserves are the oil deposits that have a high degree of certainty of being commercially recoverable based on geological and engineering data. These reserves have been drilled and tested, and their existence and size are well established. Probable reserves, on the other hand, have a lower degree of certainty compared to proven reserves. They are estimated to have a reasonable chance of being commercially recoverable based on geological and engineering data, but further exploration and appraisal are required to confirm their size and viability. Possible reserves are the least certain category and are estimated to have a lower chance of being commercially recoverable compared to proven and probable reserves. These reserves are often based on preliminary geological and engineering data and require significant additional exploration and appraisal to determine their viability. Factors to consider in evaluating oil reserves. When evaluating oil reserves, there are several key factors that investors should consider. Reserve size. The size of the oil reserves is an important factor as it determines the potential production capacity and profitability of an oil investment. Larger reserves generally offer more significant long-term opportunities for production and revenue. Reserve quality. The quality of the oil reserves refers to the characteristics of the oil, such as its API gravity, a measure of its density, and sulfur content. Higher quality oil is generally more valuable and in higher demand, leading to better pricing and profitability. Reserve recovery factor. The recovery factor is the percentage of oil that can be extracted from the total estimated reserves. A higher recovery factor indicates a more efficient and productive oil field, which can lead to increased profitability. Reserve location. The location of the oil reserves plays a crucial role in evaluating their potential profitability. Factors such as accessibility, infrastructure, political stability, and regulatory environment can significantly impact the cost of extraction and transportation, as well as the overall investment risk. Reserve economics. Evaluating the economic viability of oil reserves involves considering factors such as production costs, oil prices, and potential revenue streams. It is essential to assess whether the projected returns from the investment outweigh the associated costs and risks. Reserve replacement ratio. The reserve replacement ratio measures the ability of an oil company to replace the oil it produces with new reserves. A higher ratio indicates a company's ability to sustain production levels and ensure future profitability. Evaluating oil reserve reports. Oil companies often publish reserve reports that provide detailed information about their oil reserves. These reports are essential tools for investors to evaluate the potential of an oil investment. When reviewing reserve reports, investors should consider the following. Reserve classification. Determine the classification of the reserves proven, probable, or possible, and understand the level of certainty associated with each category. Reserve growth. Assess the historical trend of reserve growth to understand the company's ability to discover and develop new reserves over time. Reserve replacement. Evaluate the company's reserve replacement ratio to determine its ability to sustain production levels and replace depleted reserves. Reserve audits. Look for reserve audits conducted by independent third-party firms. These audits provide an additional level of credibility and assurance regarding the accuracy of the reported reserves. Reserve life. Consider the reserve life, which is the estimated number of years the company's reserves can sustain its production at current levels. A longer reserve life indicates a more stable and sustainable investment. Conclusion. Evaluating oil reserves is a critical step in oil investing. Understanding the size, quality, recovery factor, location, economics, and other factors associated with oil reserves can help investors make informed decisions and assess the potential profitability and risks of an oil investment. By carefully analyzing reserve reports and considering the relevant factors, investors can gain valuable insights into the long-term prospects of an oil company or project. 3.3 Assessing management and leadership. When it comes to investing in oil companies, one of the key factors to consider is the management and leadership of the company. The success or failure of an oil company often hinges on the decisions made by its management team. Therefore, it is crucial for investors to assess the management and leadership capabilities of the company before making any investment decisions. Importance of management and leadership. The management team of an oil company plays a critical role in its overall performance and success. They are responsible for making strategic decisions, managing operations, and navigating the complex and ever-changing landscape of the oil industry. A strong and capable management team can effectively steer the company through challenges and capitalize on opportunities, while a weak or ineffective management team can lead to poor decision-making and negative outcomes. Key factors to consider. When assessing the management and leadership of an oil company, there are several key factors to consider. Experience and expertise. One of the first things to evaluate is the experience and expertise of the management team. Look for individuals who have a deep understanding of the oil industry, including technical knowledge, operational expertise, and market insights. Experience in managing similar projects or companies can also be a valuable asset. Track record. Examine the track record of the management team. Have they successfully led the company through challenging times? Have they delivered consistent results and created value for shareholders? Look for evidence of their ability to execute strategies, manage risks, and generate profits. Communication and transparency. Effective communication is crucial in the oil industry, especially when it comes to managing investor expectations and providing timely and accurate information. Assess how transparent the management team is in their communication with shareholders and stakeholders. Look for regular updates, clear and concise reporting, and a willingness to address concerns and answer questions. Corporate governance. Evaluate the company's corporate governance practices, including the composition of the board of directors and the presence of independent directors. Strong corporate governance ensures that the interests of shareholders are protected and that decision-making is not influenced by conflicts of interest. Succession planning. Consider the company's succession planning strategy. A well-defined and robust succession plan ensures continuity and stability in leadership, even in the event of unexpected changes. Look for companies that have a clear plan in place to groom and develop future leaders. Assessing management and leadership. To assess the management and leadership of an oil company, consider the following steps. Research and analysis. Start by conducting thorough research on the company and its management team. Review their backgrounds, qualifications, and track records. Look for any news or articles that provide insights into their leadership style and decision-making approach. Financial performance. Evaluate the company's financial performance over time. Look for consistent revenue growth, profitability, and strong cash flow generation. Assess how the management team has managed costs and capital allocation. Industry reputation. Consider the reputation of the management team within the industry. Are they well respected and recognized for their expertise? Look for any awards or accolades that highlight their achievements and contributions to the industry. Interviews and meetings. Whenever possible, try to meet with members of the management team. This can provide valuable insights into their communication style, vision for the company, and their ability to articulate their strategies and plans. Ask questions about their approach to risk management, their long-term vision for the company, and their plans for growth and innovation. Peer comparison. Compare the management team of the company with its peers in the industry. Look for companies that have consistently outperformed their competitors and assess what role the management team played in their success. Conclusion. Assessing the management and leadership of an oil company is a critical step in the investment process. A strong and capable management team can significantly enhance the chances of success, while a weak or ineffective team can lead to poor performance and negative outcomes. By considering factors such as experience, track record, communication, corporate governance, and succession planning, investors can make more informed decisions and increase their chances of successful oil investing. To invest in oil, there are several options available to you. Here are some common ways to invest in oil. Investing in oil stocks. One of the most popular ways to invest in oil is by purchasing stocks of oil companies. This allows you to indirectly invest in the oil industry and benefit from the performance of these companies. When considering oil stocks, it is important to research and analyze the financial health, management, and growth potential of the companies you are interested in. Investing in oil ETFs. Exchange-traded funds (ETFs) are investment funds that trade on stock exchanges. There are ETFs specifically focused on the oil industry, which allow investors to gain exposure to a diversified portfolio of oil-related assets. Investing in oil ETFs can be a convenient way to invest in the oil sector without having to select individual stocks. Investing in oil futures and options. Futures and options contracts are financial derivatives that allow investors to speculate on the future price of oil. These contracts provide the opportunity to profit from price movements in the oil market without owning the physical commodity. However, trading futures and options can be complex and risky, requiring a good understanding of the market and careful risk management. Investing in oil mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of securities, including oil-related assets. Investing in oil mutual funds can provide exposure to a range of oil companies and other oil-related investments. It is important to carefully review the fund's investment strategy, fees, and historical performance before investing. Investing in oil exploration and production companies. Another way to invest in oil is by directly investing in companies involved in oil exploration and production. These companies are responsible for finding and extracting oil from the ground. Investing in exploration and production companies can be more volatile and risky compared to investing in larger, more established oil companies. Investing in oil refining and marketing companies. Refining and marketing companies are involved in the processing, distribution, and sale of oil and oil products. Investing in these companies can provide exposure to different aspects of the oil industry, such as refining, transportation, and retail. It is important to evaluate the financial health, competitive position, and growth prospects of these companies before investing. Investing in oilfield services companies. Oilfield services companies provide various services and equipment to support oil exploration, production, and transportation. These companies play a crucial role in the oil industry and can be an attractive investment opportunity. Before investing, it is important to assess the financial stability, customer base, and competitive advantage of these companies. Investing in oil commodities. Investing directly in oil commodities involves buying and selling physical barrels of oil. This can be done through commodity exchanges or specialized trading platforms. Investing in oil commodities requires a good understanding of the market, supply and demand dynamics, and the ability to store and transport the physical commodity. When investing in oil, it is important to consider the risks associated with the industry. Oil prices can be volatile and influenced by various factors such as geopolitical events, economic conditions, and supply and demand dynamics. It is advisable to diversify your investments and consult with a financial advisor to determine the most suitable investment strategy based on your financial goals and risk tolerance. Remember to conduct thorough research, stay informed about the latest developments in the oil industry, and regularly review your investment portfolio to ensure it aligns with your investment objectives. 3.5 Analyzing oil company performance. When it comes to investing in oil, one of the key factors to consider is the performance of oil companies. Analyzing the performance of oil companies can provide valuable insights into their financial health, operational efficiency, and overall potential for growth. In this section, we will explore the various metrics and indicators that can be used to evaluate the performance of oil companies. Financial performance metrics. One of the first aspects to consider when analyzing oil company performance is their financial performance. This can be assessed through a range of financial metrics that provide insights into the company's profitability, liquidity, and solvency. Some of the key financial performance metrics to consider include revenue. Revenue is the total income generated by the oil company from its operations. It is important to analyze the revenue growth over time to assess the company's ability to generate consistent income. Net income. Net income is the profit earned by the company after deducting all expenses, including taxes. It is a crucial metric to evaluate the profitability of the company. Return on equity (ROE) measures the company's ability to generate profits from the shareholders' equity. A higher ROE indicates better profitability and efficient use of shareholders' investments. Debt to equity ratio. This ratio indicates the proportion of debt to equity in the company's capital structure. A high debt to equity ratio may indicate higher financial risk, as it suggests that the company relies heavily on borrowed funds. Cash flow. Analyzing the cash flow of an oil company is essential to understand its ability to generate cash from its operations. Positive cash flow is crucial for funding future investments and paying dividends. Operational performance indicators. In addition to financial metrics, it is important to assess the operational performance of oil companies. These indicators provide insights into the company's production efficiency, reserves, and exploration success. Some of the key operational performance indicators to consider include production volume. Analyzing the production volume of an oil company is crucial to understand its ability to meet demand and generate revenue. It is important to assess the company's production growth over time and compare it with industry peers. Reserves replacement ratio. This ratio measures the company's ability to replace its reserves through exploration and production activities. A higher ratio indicates a healthier reserve base and potential for future growth. Exploration success rate. This metric assesses the company's success in discovering new oil reserves through exploration activities. A higher success rate indicates better exploration capabilities and potential for future growth. Operating efficiency. Analyzing the company's operating efficiency metrics, such as production costs per barrel or operating expenses as a percentage of revenue, can provide insights into its cost management and operational effectiveness. Stock performance and market indicators. Another important aspect of analyzing oil company performance is assessing their stock performance and market indicators. These indicators provide insights into the market's perception of the company's prospects and its ability to create shareholder value. Some of the key stock performance and market indicators to consider include stock price performance. Analyzing the historical stock price performance of an oil company can provide insights into its market performance and investor sentiment. It is important to compare the company's stock performance with industry peers and broader market indices. Market capitalization. Market capitalization reflects the total market value of a company's outstanding shares. It is an important indicator of the company's size and market perception. Dividend yield. Dividend yield measures the annual dividend payment as a percentage of the stock price. It is an important indicator for income-focused investors and reflects the company's ability to distribute profits to shareholders. Price-to-earnings (PE) ratio. The PE ratio compares the company's stock price to its earnings per share. It is a widely used valuation metric that helps assess the company's relative value compared to its earnings. Beta. Beta measures the volatility of a stock relative to the overall market. A beta greater than 1 indicates higher volatility, while a beta less than 1 indicates lower volatility. Comparative analysis and industry benchmarks. When analyzing oil company performance, it is important to conduct a comparative analysis and benchmark the company against its industry peers. This allows investors to assess the company's performance relative to its competitors and industry standards. Some of the key comparative analysis and industry benchmarks to consider include financial ratios. Comparing the financial ratios of an oil company with its industry peers can provide insights into its relative financial health and performance. Operational metrics. Analyzing operational metrics, such as production volume or reserves replacement ratio, in comparison to industry benchmarks can help assess the company's operational efficiency and competitiveness. Stock performance. Comparing the stock performance of an oil company with its industry peers and broader market indices can provide insights into its relative market performance and investor sentiment. Industry trends. Staying updated with industry trends and developments is crucial when analyzing oil company performance. This allows investors to assess the company's ability to adapt to changing market dynamics and capitalize on emerging opportunities. By analyzing the financial performance, operational indicators, stock performance, and conducting comparative analysis, investors can gain a comprehensive understanding of an oil company's performance. This analysis can help inform investment decisions and identify companies with strong growth potential and solid fundamentals. However, it is important to note that analyzing oil company performance is just one aspect of successful oil investing, and investors should consider a holistic approach that incorporates other factors such as market conditions, geopolitical risks, and diversification strategies. 3.6 Exploring oil company risks. Investing in oil companies can be a lucrative venture, but it is important to understand the risks involved. While oil investments can offer significant returns, they also come with their fair share of challenges and uncertainties. In this section, we will explore some of the key risks associated with investing in oil companies. 1. Volatility in oil prices. One of the primary risks in oil investing is the volatility of oil prices. Oil prices are influenced by a multitude of factors, including global supply and demand dynamics, geopolitical tensions, and economic conditions. These factors can cause significant fluctuations in oil prices, which can impact the profitability of oil companies. Investors need to be prepared for sudden price swings and the potential for significant losses. It is crucial to closely monitor oil price trends and stay informed about the factors that can influence them. Additionally, diversifying your portfolio across different oil investments can help mitigate the impact of price volatility. 2. Geopolitical and regulatory risks. Oil investments are also exposed to geopolitical and regulatory risks. Political instability in oil-producing regions can disrupt oil supply and impact prices. Conflicts, sanctions, and changes in government policies can create uncertainties for oil companies and investors. Regulatory changes and environmental regulations can also affect the profitability of oil companies. Governments may impose stricter regulations on oil exploration, production, and emissions, which can increase costs and limit operations. Investors need to stay updated on geopolitical developments and regulatory changes that can impact the oil industry. 3. Exploration and production risks. Investing in oil exploration and production companies carries specific risks related to the exploration and extraction process. Exploration activities involve significant upfront costs, and there is always the possibility of unsuccessful drilling or dry wells. The success of exploration projects depends on factors such as geological conditions, technological advancements, and the expertise of the company's management. Production risks include operational challenges, such as equipment failures, accidents, and natural disasters. These risks can disrupt production and impact the financial performance of oil companies. Investors should carefully evaluate the track record and capabilities of exploration and production companies before investing. 4. Environmental and social risks. Environmental and social risks are increasingly important considerations in oil investing. The oil industry has faced criticism for its impact on the environment, including carbon emissions, water pollution, and habitat destruction. Concerns about climate change and sustainability have led to increased scrutiny and pressure on oil companies to adopt more environmentally friendly practices. Investors need to assess the environmental and social performance of oil companies they are considering investing in. Companies with strong environmental and social governance practices may be better positioned to navigate regulatory changes and public sentiment. Additionally, investing in renewable energy companies can provide exposure to the energy sector while mitigating some of the environmental risks associated with traditional oil investments. 5. Financial risks. Like any investment, oil investments carry financial risks. Oil companies can face challenges related to debt levels, cash flow, and profitability. Factors such as high production costs, low oil prices, and excessive leverage can strain the financial health of oil companies. Investors should carefully analyze the financial statements and ratios of oil companies to assess their financial stability and ability to weather market downturns. It is important to consider factors such as debt-to-equity ratio, liquidity, and profitability metrics. Diversifying investments across different oil companies and sectors can help mitigate financial risks. 6. Technological risks. The oil industry is constantly evolving, and technological advancements play a crucial role in exploration, production, and refining processes. However, technological risks exist, particularly for companies that fail to adapt and embrace new technologies. Investors should evaluate the technological capabilities and innovation strategies of oil companies. Companies that invest in research and development, adopt new technologies, and stay ahead of industry trends may be better positioned for long-term success. Conclusion. Investing in oil companies can be a rewarding endeavor, but it is essential to understand and manage the risks involved. Volatility in oil prices, geopolitical and regulatory uncertainties, exploration and production risks, environmental and social considerations, financial challenges, and technological advancements are all factors that can impact the performance of oil investments. By conducting thorough research, diversifying your portfolio, and staying informed about industry trends, you can make more informed investment decisions and navigate the risks associated with oil investing. It is also advisable to consult with financial advisors or professionals who specialize in the oil industry to gain additional insights and guidance. 4. Investing in oil exploration and production. 4.1 Understanding the exploration and production process. Investing in oil exploration and production can be a lucrative opportunity for investors looking to capitalize on the global demand for energy. However, before diving into this sector, it is essential to have a solid understanding of the exploration and production process. This section will provide you with a comprehensive overview of how oil is discovered, extracted, and brought to market. The exploration process. The first step in the oil production cycle is exploration. Oil companies employ various techniques to identify potential oil reserves beneath the Earth's surface. These techniques include seismic surveys, gravity and magnetic surveys, and exploratory drilling. Seismic surveys involve sending sound waves into the ground and measuring the echoes that bounce back. By analyzing these echoes, geologists can create detailed maps of the subsurface, identifying potential oil-bearing formations. Gravity and magnetic surveys, on the other hand, measure variations in the Earth's gravitational and magnetic fields, which can indicate the presence of underground oil reservoirs. Once a potential oil-bearing area is identified, exploratory drilling is conducted. This involves drilling test wells to determine the presence and quality of oil. If the results are promising, further drilling and testing are carried out to assess the size and commercial viability of the oil reservoir. The production process. Once an oil reservoir is deemed commercially viable, the production phase begins. This involves several steps to extract the oil and prepare it for transportation and refining. Drilling. The first step in the production process is drilling production wells. These wells are typically drilled vertically into the oil reservoir, but in some cases, horizontal drilling may be employed to access hard-to-reach reserves. The wells are lined with steel casing to prevent collapse and to isolate the oil-bearing formations from surrounding rock layers. Completion. After drilling, the wells are completed to facilitate the flow of oil. This involves installing production tubing, which allows the oil to flow to the surface, and casing perforations, which create channels for the oil to enter the wellbore. Production. Once the wells are completed, the oil can be produced. In some cases, the natural pressure within the reservoir is sufficient to push the oil to the surface. This is known as primary production. However, in many cases, additional methods are required to enhance oil recovery. These methods include secondary recovery techniques such as water flooding, where water is injected into the reservoir to displace the oil, and tertiary recovery techniques such as steam injection or chemical flooding. Surface facilities. As the oil is produced, it is transported to surface facilities for processing and storage. These facilities include separators, which separate the oil from any associated gas and water, and storage tanks, where the oil is stored before being transported to refineries or other markets. Transportation. Once the oil is processed and stored, it needs to be transported to refineries or other markets. This is typically done through pipelines, tanker ships, or railroads, depending on the location and infrastructure available. Environmental considerations. It is important to note that oil exploration and production can have significant environmental impacts. The extraction process can result in the release of greenhouse gases, the contamination of water sources, and the disruption of ecosystems. As an investor, it is crucial to consider the environmental practices and policies of the companies you are investing in and to assess their commitment to sustainable and responsible operations. Conclusion. Understanding the exploration and production process is essential for investors looking to enter the oil industry. By familiarizing yourself with the steps involved in discovering and extracting oil, you can make more informed investment decisions. Additionally, considering the environmental implications of oil production can help you identify companies that prioritize sustainability and responsible practices. With this knowledge, you can navigate the oil exploration and production sector with confidence and maximize your investment potential. 4.2 Evaluating exploration and production companies. Investing in oil exploration and production companies can be a lucrative opportunity for investors looking to capitalize on the potential profits of the oil industry. However, it is essential to evaluate these companies carefully before making any investment decisions. This section will guide you through the process of evaluating exploration and production companies to help you make informed investment choices. Understanding the exploration and production process. Before diving into the evaluation process, it is crucial to have a basic understanding of the exploration and production (E&P) process. Exploration involves searching for potential oil and gas reserves through geological surveys, seismic testing, and drilling exploratory wells. Once a viable reserve is discovered, production begins, involving the extraction and processing of oil and gas from the reservoir. Exploration and production companies are involved in various stages of this process, from initial exploration to full-scale production. Evaluating these companies requires a comprehensive analysis of their financial health, operational capabilities, and growth potential. Key factors to consider. When evaluating exploration and production companies, several key factors should be considered. 1. Financial performance and stability. Assessing the financial performance and stability of a company is crucial. Review the company's financial statements, including its balance sheet, income statement, and cash flow statement. Look for consistent revenue growth, profitability, and positive cash flow. Analyze the company's debt levels and its ability to meet its financial obligations. 2. Reserves and production potential. Evaluate the company's oil and gas reserves and its production potential. Consider the size, quality, and location of the reserves. Look for companies with proven reserves and a track record of successful production. Assess the company's ability to replace reserves through exploration and acquisitions. 3. Operational efficiency and expertise. Examine the company's operational efficiency and expertise. Evaluate its track record in exploration and production activities. Consider factors such as drilling success rates, production costs, and technological advancements. Companies with efficient operations and a history of successful projects are more likely to generate higher returns. 4. Management team and leadership. Assess the management team and leadership of the company. Look for experienced executives with a strong track record in the oil and gas industry. Evaluate their strategic vision, decision-making capabilities, and ability to navigate challenges. A competent management team can significantly impact the company's success. 5. Regulatory and environmental considerations. Consider the regulatory and environmental factors that may impact the company's operations. Evaluate the company's compliance with industry regulations and its commitment to environmental sustainability. Companies with strong environmental practices and a proactive approach to regulatory compliance are more likely to mitigate risks and maintain long-term viability. 6. Industry and market trends. Stay informed about industry and market trends that may impact exploration and production companies. Monitor factors such as oil prices, global demand, geopolitical events, and technological advancements. Understanding these trends can help you assess the company's growth potential and identify potential risks. Research and analysis. To evaluate exploration and production companies effectively, conduct thorough research and analysis. Here are some steps to follow. 1. Company research. Start by researching individual exploration and production companies. Gather information from reliable sources such as company websites, financial reports, industry publications, and news articles. Understand the company's history, operations, financial performance, and growth prospects. 2. Financial analysis. Perform a detailed financial analysis of the company. Analyze its financial statements, including revenue, profitability, cash flow, and debt levels. Compare the company's financial performance to its competitors and industry benchmarks. Look for consistent growth, strong profitability, and a healthy balance sheet. 3. Industry comparison. Compare the company's performance and metrics to its industry peers. Evaluate factors such as production levels, reserves, operational efficiency, and financial ratios. This analysis will help you assess the company's competitive position within the industry. 4. Risk assessment. Identify and assess the risks associated with the company's operations. Consider factors such as geopolitical risks, regulatory changes, environmental concerns, and commodity price volatility. Evaluate the company's risk management strategies and its ability to mitigate these risks. 5. Valuation. Determine the company's valuation by analyzing its financial metrics, industry multiples, and future growth prospects. Consider valuation methods such as price-to-earnings ratio, price-to-book ratio, and discounted cash flow analysis. Compare the company's valuation to its peers to assess its investment potential. Conclusion. Evaluating exploration and production companies requires a comprehensive analysis of various factors, including financial performance, reserves, operational efficiency, management, regulatory compliance, and industry trends. By conducting thorough research and analysis, you can make informed investment decisions and maximize your chances of success in the oil industry. Remember to diversify your portfolio and consult with financial professionals before making any investment decisions. 4.3 Assessing exploration and production risks. Investing in oil exploration and production can be a lucrative venture, but it also comes with its fair share of risks. Before diving into this sector, it is crucial to thoroughly assess and understand the risks involved. This section will provide you with an overview of the key risks associated with oil exploration and production investments. Geopolitical risks. One of the most significant risks in the oil exploration and production sector is geopolitical instability. Political conflicts, wars, and sanctions can disrupt oil production and supply, leading to price volatility. It is essential to stay informed about geopolitical events and their potential impact on oil-producing regions. Understanding the political landscape of oil-rich countries and their relationships with other nations can help you assess the level of geopolitical risk. Regulatory and environmental risks. Oil exploration and production are subject to stringent regulations and environmental standards. Changes in regulations can significantly impact the profitability of oil projects. Environmental risks, such as oil spills or accidents, can result in substantial financial liabilities and reputational damage for companies involved. It is crucial to evaluate the regulatory environment and the track record of companies in adhering to environmental standards before making investment decisions. Technological risks. The oil industry is constantly evolving, and technological advancements play a crucial role in exploration and production activities. However, investing in new technologies also comes with risks. New drilling techniques or extraction methods may not always yield the expected results, leading to financial losses. It is important to assess the technological capabilities and innovation strategies of oil companies to determine their ability to adapt to changing industry dynamics. Price volatility. Oil prices are highly volatile and can be influenced by various factors such as supply and demand dynamics, geopolitical events, and economic conditions. Fluctuations in oil prices can significantly impact the profitability of exploration and production projects. It is essential to have a thorough understanding of the factors affecting oil prices and closely monitor market trends to make informed investment decisions. Reservoir and production risks. Exploration and production activities involve inherent risks related to reservoir quality and production potential. The success of an oil project depends on the ability to accurately estimate the size and quality of the reservoir, as well as the production rates. Factors such as reservoir complexity, well performance, and recovery techniques can impact the ultimate recovery of oil. It is crucial to evaluate the technical expertise and track record of oil companies in successfully developing and producing from oil fields. Financial risks. Investing in oil exploration and production requires significant capital investments. Companies in this sector often carry high levels of debt to finance their operations. Financial risks include the ability of companies to generate sufficient cash flow to cover their debt obligations, interest rate fluctuations, and access to capital markets. It is important to assess the financial health and leverage levels of oil companies before making investment decisions. Operational risks. Oil exploration and production involve complex and high-risk operations. Operational risks include accidents, equipment failures, and project delays. These risks can result in production disruptions, cost overruns, and potential safety hazards. It is crucial to evaluate the operational capabilities, safety records, and risk management practices of oil companies before investing. Market risks. The oil market is influenced by global economic conditions, energy policies, and technological advancements. Changes in market dynamics can impact the demand for oil and the profitability of exploration and production projects. It is important to stay informed about market trends, energy transition initiatives, and emerging technologies that could disrupt the oil industry. Conclusion. Assessing the risks associated with oil exploration and production investments is crucial for making informed investment decisions. Geopolitical risks, regulatory and environmental risks, technological risks, price volatility, reservoir and production risks, financial risks, operational risks, and market risks are some of the key factors to consider. By thoroughly evaluating these risks and conducting comprehensive due diligence, you can mitigate potential pitfalls and increase your chances of successful oil investing. 4.4 Investing in oilfield services companies. Investing in oilfield services companies can be a lucrative opportunity for investors looking to diversify their portfolio within the oil industry. Oilfield services companies play a crucial role in the exploration, production, and maintenance of oil and gas wells. They provide a range of services, including drilling, well construction, equipment rental, and maintenance. Understanding the oilfield services sector. The oilfield services sector is an integral part of the oil and gas industry. These companies support the upstream activities of exploration and production companies by providing the necessary equipment, technology, and expertise. Oilfield services companies operate globally and work in various environments, including onshore and offshore drilling sites. Investing in oilfield services companies can offer investors exposure to the oil industry without the direct risks associated with exploration and production activities. These companies generate revenue by providing services to oil and gas companies on a contractual basis. Their performance is closely tied to the level of drilling and production activities in the industry. Evaluating oilfield services companies. When evaluating oilfield services companies for investment, it is essential to consider several factors. Financial performance. Assess the company's financial health by analyzing its revenue growth, profitability, and cash flow. Look for companies with a strong balance sheet and a history of consistent financial performance. Market position. Evaluate the company's market position and competitive advantage. Consider factors such as the company's reputation, customer base, and technological capabilities. Companies with a strong market position are more likely to secure contracts and maintain stable revenue streams. Management team. Assess the management team's experience, track record, and strategic vision. A competent and experienced management team is crucial for navigating the cyclical nature of the oil industry and making sound business decisions. Customer base. Consider the company's customer base and the diversity of its clients. A well-diversified customer base reduces the risk of over-reliance on a single client or project. Technological capabilities. Evaluate the company's technological capabilities and its ability to adapt to changing industry trends. Companies that invest in innovative technologies and have a competitive edge in providing specialized services are more likely to succeed in the long term. Assessing oilfield services risks. Investing in oilfield services companies comes with its own set of risks. It is crucial to understand and assess these risks before making investment decisions. Oil price volatility. Oilfield services companies are indirectly exposed to oil price fluctuations. When oil prices are low, exploration and production activities tend to decrease, leading to reduced demand for services. Conversely, during periods of high oil prices, demand for services may increase. Understanding the correlation between oil prices and the company's performance is essential. Competition. The oilfield services sector is highly competitive, with numerous companies vying for contracts. Intense competition can lead to pricing pressures and reduced profit margins. Evaluate the company's competitive position and its ability to differentiate itself from competitors. Regulatory and environmental risks. Oilfield services companies operate in a heavily regulated industry. Changes in regulations or environmental policies can impact their operations and profitability. Stay informed about regulatory developments and assess the company's ability to comply with evolving standards. Geopolitical risks. Political instability, conflicts, and sanctions in oil-producing regions can disrupt operations and impact the profitability of oilfield services companies. Evaluate the company's exposure to geopolitical risks and its ability to mitigate them. Investing in oilfield technology and equipment. Investors interested in oilfield services companies can also consider investing in companies that provide specialized technology and equipment to the industry. These companies develop and supply advanced drilling equipment, software solutions, and other technologies that enhance the efficiency and safety of oilfield operations. Investing in oilfield technology and equipment companies can offer exposure to the oil industry while focusing on specific niches within the sector. These companies often have long-term contracts with oilfield services providers and exploration companies, providing a stable revenue stream. When evaluating oilfield technology and equipment companies, consider factors such as technological innovation, market demand for their products, and the company's financial performance. Assess the company's ability to develop and commercialize new technologies that address industry challenges and improve operational efficiency. In conclusion, investing in oilfield services companies and related technology and equipment providers can be a viable option for investors seeking exposure to the oil industry. However, it is crucial to conduct thorough research, evaluate the financial performance and market position of these companies, and assess the associated risks. By diversifying your portfolio and staying informed about industry trends, you can make informed investment decisions in the oilfield services sector. 5. Investing in oil refining and marketing. To invest in oil, there are several options available to you. Here are some common ways to invest in oil. Investing in oil stocks. One of the most popular ways to invest in oil is by purchasing stocks of oil companies. These companies are involved in various aspects of the oil industry, including exploration, production, refining, and marketing. By investing in oil stocks, you can participate in the potential growth and profitability of these companies. Investing in oil ETFs. Exchange-traded funds (ETFs) are investment funds that trade on stock exchanges. There are ETFs specifically designed to track the performance of oil-related companies or oil price indexes. By investing in oil ETFs, you can gain exposure to the oil industry without having to buy individual stocks. Investing in oil futures and options. Futures and options contracts allow investors to speculate on the future price of oil. These derivative instruments are traded on commodity exchanges and can provide opportunities for profit if you correctly predict the direction of oil prices. However, trading futures and options can be complex and risky, and it requires a good understanding of the market. Investing in oil mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of securities, including oil-related stocks and bonds. By investing in oil mutual funds, you can benefit from professional management and diversification, which can help reduce risk. Investing in oil exploration and production. Another way to invest in oil is by directly investing in companies involved in oil exploration and production. These companies are responsible for finding and extracting oil from the ground. Investing in exploration and production companies can be more volatile and risky compared to investing in larger, more established oil companies. Investing in oil refining and marketing. Oil refining and marketing companies are involved in the processing, distribution, and sale of refined oil products. These companies take crude oil and refine it into various products such as gasoline, diesel, and jet fuel. Investing in refining and marketing companies can provide exposure to the downstream segment of the oil industry. Investing in oilfield services. Oilfield services companies provide various services and equipment to the oil industry, including drilling, well maintenance, and equipment rental. Investing in oilfield services companies can be a way to indirectly participate in the oil industry by supporting the operations of oil exploration and production companies. Investing in oil commodities. Investing in oil commodities involves buying and selling physical barrels of oil. This can be done through commodity exchanges or through specialized platforms. Investing in oil commodities requires knowledge of the market and the ability to store and transport physical oil. When investing in oil, it is important to consider the risks involved. Oil prices can be volatile and are influenced by various factors such as supply and demand dynamics, geopolitical events, and economic conditions. It is also important to conduct thorough research and analysis before making any investment decisions. Consider consulting with a financial advisor or investment professional who specializes in the oil industry to help guide your investment strategy. To invest in oil, there are several options available to you. Here are some common ways to invest in oil. Investing in oil stocks. One of the most popular ways to invest in oil is by purchasing stocks of oil companies. These companies are involved in various aspects of the oil industry, including exploration, production, refining, and marketing. When investing in oil stocks, it is important to research and analyze the financial health, management, and growth prospects of the companies you are considering. Investing in oil ETFs. Exchange-traded funds (ETFs) are investment funds that trade on stock exchanges, similar to stocks. Oil ETFs allow investors to gain exposure to the oil industry without directly owning individual stocks. These funds typically track the performance of oil-related indexes or invest in a diversified portfolio of oil-related assets. Investing in oil futures and options. Futures and options contracts are financial derivatives that allow investors to speculate on the future price of oil. Futures contracts obligate the buyer to purchase a specified quantity of oil at a predetermined price and date, while options contracts give the buyer the right, but not the obligation, to buy or sell oil at a specific price within a certain time frame. Investing in oil mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of securities, including oil-related assets. Oil mutual funds are managed by professional fund managers who make investment decisions on behalf of the investors. These funds provide exposure to a broad range of oil-related companies and can be a convenient way to invest in the oil industry. Before investing in oil, it is important to consider the following factors. Market analysis. Stay informed about the current trends and developments in the oil industry. Monitor oil prices, supply and demand dynamics, geopolitical events, and regulatory changes that may impact the industry. Risk assessment. Understand the risks associated with investing in oil. These may include price volatility, geopolitical risks, environmental concerns, and regulatory changes. Assess your risk tolerance and determine how much exposure to the oil industry is suitable for your investment portfolio. Diversification. Consider diversifying your oil investments across different sectors of the industry, such as exploration and production, refining and marketing, oilfield services, and commodities. This can help mitigate risks and take advantage of opportunities in different segments of the oil industry. Financial analysis. When evaluating oil companies or funds, analyze their financial statements, including revenue, earnings, debt levels, and cash flow. Look for companies with strong financials, a history of profitability, and a solid balance sheet. Long-term outlook. Consider the long-term outlook for the oil industry. As the world transitions towards renewable energy sources, the demand for oil may change over time. Evaluate how oil companies are adapting to these changes and consider investing in companies that are well-positioned for the future. Seek professional advice. If you are unsure about investing in oil or need assistance in building a diversified portfolio, consider consulting with a financial advisor or investment professional who specializes in the energy sector. They can provide personalized guidance based on your investment goals and risk tolerance. Remember, investing in oil carries risks, and it is important to conduct thorough research and due diligence before making any investment decisions. Stay informed, diversify your portfolio, and regularly review and adjust your investment strategy as needed. 5.3 Assessing refining and marketing risks. Investing in oil refining and marketing companies can be a lucrative opportunity for investors looking to capitalize on the downstream sector of the oil industry. However, like any investment, it is important to assess the risks involved before committing your capital. In this section, we will explore some of the key risks associated with investing in oil refining and marketing and provide guidance on how to assess and manage these risks effectively. Market volatility. One of the primary risks in the refining and marketing sector is market volatility. Oil prices can fluctuate significantly due to various factors such as geopolitical tensions, supply and demand imbalances, and economic conditions. These price fluctuations can impact the profitability of refining and marketing companies, as they buy crude oil and sell refined products at market prices. To assess the risk of market volatility, it is essential to analyze the historical price trends of crude oil and refined products. Look for patterns and correlations between oil prices and refining margins. Additionally, stay updated on global events and market news that could potentially impact oil prices. By understanding the factors that drive market volatility, you can make more informed investment decisions and adjust your strategy accordingly. Refining margins. Refining margins, also known as crack spreads, play a crucial role in the profitability of refining and marketing companies. Refining margins represent the difference between the cost of crude oil and the value of the refined products produced. These margins can vary significantly depending on factors such as regional supply and demand dynamics, refinery capacity utilization, and regulatory changes. To assess the risk associated with refining margins, analyze the historical trends and volatility of crack spreads. Look for patterns and correlations with other market indicators such as oil prices, gasoline demand, and refining capacity utilization rates. Additionally, consider the competitive landscape within the refining sector, as intense competition can put pressure on refining margins. By understanding the factors that influence refining margins, you can better evaluate the potential risks and rewards of investing in refining and marketing companies. Regulatory and environmental risks. The refining and marketing sector is subject to various regulatory and environmental risks. Governments impose regulations to ensure safety, environmental protection, and compliance with quality standards. These regulations can impact the operations and profitability of refining and marketing companies. Additionally, environmental concerns and the transition towards cleaner energy sources pose long-term risks to the sector. To assess regulatory and environmental risks, analyze the regulatory framework in the regions where the companies operate. Understand the compliance requirements and the potential impact on costs and operations. Additionally, consider the company's track record in environmental stewardship and their efforts towards sustainability. Companies that proactively address regulatory and environmental risks may be better positioned for long-term success. Competitive landscape. The refining and marketing sector is highly competitive, with numerous players vying for market share. The level of competition can impact the profitability and growth prospects of individual companies. Factors such as economies of scale, access to crude oil supply, distribution networks, and brand recognition can give certain companies a competitive advantage. To assess the competitive landscape, analyze the market share and positioning of the companies you are considering investing in. Look for companies with a strong market presence, diversified customer base, and strategic advantages such as proprietary technologies or access to unique crude oil sources. Additionally, monitor industry trends and developments that could impact the competitive dynamics. By understanding the competitive landscape, you can make more informed investment decisions and identify companies with a sustainable competitive advantage. Financial health and debt levels. Another important aspect to consider when assessing the risks of investing in refining and marketing companies is their financial health and debt levels. Companies with high levels of debt may be more vulnerable to economic downturns or changes in interest rates. Additionally, the capital-intensive nature of the refining sector requires significant investments in maintenance, upgrades, and expansion projects. To assess the financial health of refining and marketing companies, analyze their financial statements, including balance sheets, income statements, and cash flow statements. Look for indicators of profitability, liquidity, and solvency. Additionally, consider the company's debt levels and debt maturity profile. A company with a strong balance sheet and manageable debt levels may be better positioned to weather economic uncertainties and invest in growth opportunities. Conclusion. Investing in oil refining and marketing companies can offer attractive opportunities for investors. However, it is crucial to assess and manage the risks associated with this sector effectively. By evaluating market volatility, refining margins, regulatory and environmental risks, competitive landscape, and financial health, you can make more informed investment decisions and build a well-rounded portfolio. Remember to conduct thorough research, stay updated on industry trends, and consult with financial professionals if needed. 5.4 Investing in oil transportation and storage. Investing in oil transportation and storage can be a lucrative opportunity for investors looking to capitalize on the global demand for oil. As oil is a highly valuable commodity, it requires efficient and reliable transportation and storage infrastructure to ensure its smooth flow from production sites to refineries and end consumers. In this section, we will explore the various aspects of investing in oil transportation and storage and provide you with valuable insights to help you make informed investment decisions. Understanding the importance of oil transportation and storage. Oil transportation and storage play a critical role in the oil industry's supply chain. Efficient transportation systems are necessary to move oil from production sites, such as oil fields or offshore drilling platforms, to refineries and distribution centers. Similarly, adequate storage facilities are essential to store excess oil and maintain strategic reserves. Investing in oil transportation and storage can offer several advantages. Firstly, it provides exposure to a crucial segment of the oil industry that is essential for the smooth functioning of the entire sector. Secondly, it can provide a stable income stream as transportation and storage companies often generate revenue through long-term contracts with oil producers and refiners. Lastly, investing in this sector can act as a hedge against oil price volatility, as transportation and storage companies are less directly affected by short-term price fluctuations. Types of oil transportation and storage investments. There are several ways to invest in oil transportation and storage, each with its own set of advantages and considerations. Let's explore some of the common investment options in this sector. Investing in oil tanker companies. Oil tanker companies specialize in transporting crude oil and refined petroleum products across oceans and waterways. These companies own and operate a fleet of tankers that transport oil from production regions to refineries and distribution centers worldwide. Investing in oil tanker companies can provide exposure to the global oil trade and benefit from the demand for oil transportation. Investing in pipeline companies. Pipeline companies own and operate extensive networks of pipelines that transport oil from production sites to refineries and other distribution points. These companies generate revenue through long-term contracts with oil producers and charge fees for transporting oil through their pipelines. Investing in pipeline companies can offer stable income streams and benefit from the consistent demand for oil transportation. Investing in storage facilities. Storage facilities are crucial for maintaining strategic oil reserves and storing excess oil during periods of oversupply. Investing in companies that own and operate storage facilities can provide exposure to the storage segment of the oil industry. These companies often generate revenue through leasing storage space to oil producers, refiners, and traders. Investing in logistics and infrastructure companies. Logistics and infrastructure companies play a vital role in supporting the transportation and storage of oil. These companies provide services such as terminal operations, loading and unloading facilities, and transportation logistics. Investing in logistics and infrastructure companies can offer exposure to various aspects of the oil transportation and storage sector. Factors to consider when investing in oil transportation and storage. Before investing in oil transportation and storage, it is essential to consider several factors that can impact the performance and profitability of these investments. Global oil demand and supply. The demand and supply dynamics of the global oil market significantly influence the profitability of transportation and storage investments. Understanding the current and projected trends in oil demand and supply can help you assess the potential growth opportunities and risks in this sector. Regulatory environment. The oil transportation and storage sector is subject to various regulations and safety standards. Changes in regulations, such as stricter environmental requirements or safety protocols, can impact the operations and profitability of companies in this sector. Stay updated on regulatory developments and assess their potential impact on your investments. Infrastructure and expansion plans. Evaluate the existing infrastructure and expansion plans of transportation and storage companies. Companies with well-maintained and efficient infrastructure, as well as strategic expansion plans, are better positioned to capitalize on the growing demand for oil transportation and storage services. Financial performance and stability. Analyze the financial performance and stability of the companies you are considering for investment. Look for companies with strong balance sheets, consistent revenue growth, and a track record of profitability. Additionally, consider the company's debt levels and ability to generate cash flow to meet its financial obligations. Industry trends and technological advancements. Stay informed about industry trends and technological advancements in oil transportation and storage. Innovations such as improved pipeline monitoring systems, advanced storage technologies, or the use of automation can significantly impact the efficiency and profitability of companies in this sector. Risks and challenges. Like any investment, investing in oil transportation and storage comes with its own set of risks and challenges. Some of the key risks to consider include oil price volatility. While transportation and storage companies are less directly affected by short-term oil price fluctuations, a prolonged period of low oil prices can impact the demand for their services. Monitor oil price trends and assess their potential impact on the profitability of your investments. Regulatory and environmental risks. Changes in regulations or environmental standards can impose additional costs on transportation and storage companies. Compliance with these regulations and the potential for fines or penalties can impact the financial performance of these companies. Competition and market dynamics. The oil transportation and storage sector can be highly competitive, with multiple players vying for market share. Consider the competitive landscape and the market dynamics of the companies you are considering for investment. Geopolitical risks. Geopolitical events, such as conflicts or sanctions, can disrupt oil transportation routes and impact the profitability of companies in this sector. Stay informed about geopolitical developments and assess their potential impact on your investments. Conclusion. Investing in oil transportation and storage can provide investors with exposure to a crucial segment of the oil industry. By understanding the importance of oil transportation and storage, exploring different investment options, considering relevant factors, and assessing the associated risks, investors can make informed decisions to capitalize on the opportunities in this sector. As with any investment, thorough research and due diligence are essential to maximize the potential returns and manage the risks effectively. 6. Investing in oilfield services. 6.1 Understanding the oilfield services sector. The oilfield services sector plays a crucial role in the oil and gas industry. It encompasses a wide range of activities and companies that provide specialized services and equipment to support oil exploration, production, and refining operations. Understanding the oilfield services sector is essential for investors looking to make informed decisions in the oil industry. Importance of the oilfield services sector. The oilfield services sector is vital for the smooth functioning of the oil and gas industry. It includes companies that offer a diverse range of services, such as drilling, well construction, well maintenance, seismic data acquisition, and oilfield equipment manufacturing. These services are essential for the successful exploration, production, and transportation of oil and gas resources. Oilfield services companies work closely with oil exploration and production companies, providing them with the necessary expertise, technology, and equipment to extract oil and gas from the ground. They play a critical role in maximizing the efficiency and productivity of oilfield operations, ultimately impacting the profitability of oil investments. Key players in the oilfield services sector. The oilfield services sector is comprised of various companies, ranging from large multinational corporations to smaller specialized firms. Some of the key players in the sector include Schlumberger. As one of the largest oilfield services companies in the world, Schlumberger offers a wide range of services, including drilling, reservoir characterization, production optimization, and well construction. Halliburton. Halliburton is another major player in the oilfield services sector, providing services such as drilling, well completion, production enhancement, and reservoir management. Baker Hughes. Baker Hughes specializes in oilfield services, offering solutions for drilling, evaluation, completion, and production. National Oil Well Varco. National Oil Well Varco is a leading provider of equipment and services to the oil and gas industry, focusing on drilling, production, and completion. Weatherford International. Weatherford International offers a wide range of services, including drilling, well construction, well completion, and production optimization. These companies, along with many others, provide essential services and technologies that enable oil and gas companies to operate efficiently and effectively. Services provided by oilfield services companies. Oilfield services companies offer a diverse range of services that support various stages of oil and gas operations. Some of the key services provided by these companies include drilling services. Oilfield services companies provide drilling services, including well planning, rig operations, and wellbore construction. They utilize advanced drilling technologies and equipment to extract oil and gas from the ground. Well services. Well services involve activities such as well completion, stimulation, and maintenance. Oilfield services companies provide the necessary expertise and equipment to ensure the optimal performance of oil and gas wells. Seismic data acquisition. Seismic data acquisition is crucial for identifying potential oil and gas reserves. Oilfield services companies use specialized equipment to collect and analyze seismic data, helping oil and gas companies make informed decisions about exploration and production activities. Production optimization. Oilfield services companies assist in optimizing oil and gas production by implementing advanced technologies and techniques. They help oil and gas companies maximize production rates, reduce costs, and improve overall operational efficiency. Equipment manufacturing. Some oilfield services companies specialize in manufacturing and supplying equipment for oil and gas operations. This includes drilling rigs, wellheads, pumps, valves, and other essential components. Factors to consider when evaluating oilfield services companies. When evaluating oilfield services companies for investment purposes, there are several key factors to consider. Market position. Assess the company's market position and competitive advantage within the oilfield services sector. Look for companies with a strong market presence, a diverse range of services, and a solid customer base. Financial performance. Analyze the company's financial performance, including revenue growth, profitability, and cash flow generation. Consider factors such as the company's ability to generate consistent earnings and its financial stability. Technological expertise. Evaluate the company's technological capabilities and its ability to innovate. Look for companies that invest in research and development to stay at the forefront of technological advancements in the industry. Customer relationships. Consider the company's relationships with oil and gas companies. Strong and long-standing customer relationships can indicate a company's reliability and reputation within the industry. Risk management. Assess the company's risk management practices, including its ability to mitigate operational, financial, and regulatory risks. Look for companies with robust safety protocols and a strong commitment to environmental sustainability. By considering these factors, investors can make informed decisions when evaluating oilfield services companies for potential investment opportunities. In conclusion, understanding the oilfield services sector is crucial for investors looking to make informed decisions in the oil and gas industry. The sector plays a vital role in supporting oil exploration, production, and refining operations. Key players in the sector provide a wide range of services and technologies that are essential for the efficient and profitable extraction of oil and gas resources. When evaluating oilfield services companies, investors should consider factors such as market position, financial performance, technological expertise, customer relationships, and risk management practices. By conducting thorough research and analysis, investors can identify promising investment opportunities in the oilfield services sector. 6.2 Evaluating oilfield services companies. Investing in oilfield services companies can be a lucrative opportunity for investors looking to capitalize on the oil industry. These companies provide essential services and equipment to oil exploration and production companies, making them an integral part of the oil supply chain. However, before investing in oilfield services companies, it is crucial to evaluate them thoroughly to make informed investment decisions. Understanding the oilfield services sector. The oilfield services sector encompasses a wide range of companies that support the exploration, drilling, production, and maintenance of oil and gas wells. These companies provide various services, including drilling, well completion, well intervention, well testing, and equipment rental. They also offer specialized services such as seismic data acquisition, reservoir evaluation, and oilfield infrastructure development. Oilfield services companies play a critical role in the oil industry by providing the necessary expertise, technology, and equipment to extract oil and gas from the ground efficiently. Their services are in high demand, especially during periods of increased drilling activity and exploration. Key factors to evaluate oilfield services companies. When evaluating oilfield services companies, there are several key factors to consider. 1. Financial performance and stability. Assessing the financial performance and stability of oilfield services companies is crucial. Review their financial statements, including revenue growth, profitability, and cash flow. Look for consistent revenue growth and strong profitability, as these indicate a well-managed company. Additionally, evaluate their debt levels and liquidity position to ensure they have the financial capacity to weather industry downturns. 2. Competitive advantage and market position. Examine the competitive advantage and market position of the oilfield services companies you are considering. Look for companies with unique technologies, patents, or proprietary processes that give them a competitive edge. Consider their market share and customer base to gauge their ability to attract and retain clients in a highly competitive industry. 3. Technological expertise and innovation. The oilfield services sector is constantly evolving, with new technologies and innovations driving efficiency and cost-effectiveness. Evaluate the technological expertise and innovation capabilities of the companies you are interested in. Look for companies that invest in research and development to stay at the forefront of technological advancements. Companies with a strong focus on innovation are more likely to adapt to changing industry dynamics and maintain a competitive advantage. 4. Client relationships and contracts. Assess the quality of the oilfield services company's client relationships and contracts. Look for long-term contracts with reputable oil exploration and production companies. These contracts provide stability and predictable revenue streams. Additionally, consider the diversity of their client base to mitigate the risk of over-reliance on a single client or project. 5. Safety and environmental record. The oil industry is subject to strict safety and environmental regulations. Evaluate the safety and environmental record of the oilfield services companies you are considering. Look for companies with a strong commitment to safety practices and environmental stewardship. A good safety record not only protects workers but also reduces the risk of costly accidents and legal liabilities. 6. Management team and corporate governance. The management team and corporate governance practices of oilfield services companies are crucial factors to consider. Evaluate the experience and track record of the management team, as well as their strategic vision for the company. Look for companies with a strong corporate governance structure, transparent reporting practices, and a commitment to ethical business conduct. Industry outlook and risks. Before investing in oilfield services companies, it is essential to consider the industry outlook and associated risks. The oil industry is cyclical and highly dependent on oil prices, drilling activity, and global economic conditions. A downturn in oil prices or reduced drilling activity can significantly impact the demand for oilfield services, affecting the financial performance of these companies. Additionally, geopolitical risks, Regulatory changes and environmental concerns can also impact the oil industry and, consequently, oilfield services companies. Stay informed about industry trends, market dynamics, and potential risks to make informed investment decisions. Conclusion. Evaluating oilfield services companies requires a comprehensive analysis of their financial performance, competitive advantage, technological expertise, client relationships, safety record, and management team. By considering these factors and staying informed about industry trends and risks, investors can make informed decisions when investing in oilfield services companies. Remember to diversify your portfolio and consult with a financial advisor to align your investment strategy with your financial goals and risk tolerance. 6.3 Assessing oilfield services risks. Investing in the oilfield services sector can be a lucrative opportunity for investors looking to capitalize on the growth and development of the oil and gas industry. However, like any investment, it is important to understand and assess the risks associated with investing in oilfield services companies. By evaluating these risks, investors can make informed decisions and mitigate potential losses. In this section, we will explore some of the key risks involved in investing in oilfield services and provide strategies for assessing and managing these risks. Market volatility. One of the primary risks associated with investing in oilfield services is market volatility. The oil and gas industry is highly sensitive to fluctuations in oil prices, which can have a significant impact on the demand for oilfield services. When oil prices are low, oil companies may reduce their exploration and production activities, leading to a decrease in demand for services such as drilling, well completion, and maintenance. This can result in reduced revenues and profitability for oilfield services companies. To assess the risk of market volatility, investors should closely monitor oil price trends and forecasts. Understanding the factors that influence oil prices, such as global supply and demand dynamics, geopolitical events, and economic indicators, can help investors anticipate potential fluctuations in the market. Additionally, diversifying investments across different oilfield services companies and regions can help mitigate the impact of market volatility on a portfolio. Technological advancements. Another risk in the oilfield services sector is the rapid pace of technological advancements. As new technologies emerge, older equipment and techniques may become obsolete, leading to a decrease in demand for certain services. For example, the development of advanced drilling techniques, such as horizontal drilling and hydraulic fracturing, has revolutionized the oil and gas industry and increased the efficiency of extraction. However, these advancements have also reduced the need for traditional drilling methods, impacting the demand for related services. To assess the risk of technological advancements, investors should stay informed about the latest innovations and trends in the oilfield services sector. By understanding the potential impact of new technologies on the demand for specific services, investors can make informed decisions about their investments. Additionally, investing in companies that are at the forefront of technological advancements and have a strong track record of adapting to industry changes can help mitigate this risk. Regulatory and environmental risks. Investing in oilfield services also comes with regulatory and environmental risks. The oil and gas industry is subject to various regulations and environmental standards, which can impact the operations and profitability of oilfield services companies. Changes in regulations, such as stricter emission standards or limitations on drilling activities, can increase compliance costs and restrict the growth opportunities for these companies. To assess regulatory and environmental risks, investors should closely monitor changes in regulations and environmental policies that may impact the oil and gas industry. Understanding the potential implications of these changes on the operations and financial performance of oilfield services companies is crucial for making informed investment decisions. Additionally, investing in companies that prioritize environmental sustainability and have a strong track record of compliance can help mitigate regulatory and environmental risks. Financial and operational risks. Like any investment, oilfield services companies are exposed to financial and operational risks. These risks can include factors such as high debt levels, cash flow volatility, project delays, and cost overruns. It is important for investors to assess the financial health and operational efficiency of oilfield services companies before making investment decisions. To assess financial and operational risks, investors should analyze key financial metrics such as revenue growth, profitability, debt levels, and cash flow stability. Evaluating the company's management team and their track record in delivering projects on time and within budget is also important. Additionally, conducting thorough due diligence and reviewing the company's financial statements, annual reports, and industry benchmarks can provide valuable insights into the company's financial and operational risks. Geopolitical risks. Investing in the oilfield services sector also involves geopolitical risks. The oil and gas industry is highly influenced by geopolitical events, such as conflicts, sanctions, and political instability in oil-producing regions. These events can disrupt the supply of oil and impact the profitability of oilfield services companies. To assess geopolitical risks, investors should stay informed about geopolitical developments that may impact the oil and gas industry. Monitoring news and analysis from reputable sources can help investors anticipate potential risks and adjust their investment strategies accordingly. Additionally, diversifying investments across different regions and considering the political stability of oil-producing countries can help mitigate geopolitical risks. In conclusion, investing in oilfield services can be a rewarding opportunity, but it is important to assess and manage the associated risks. By evaluating market volatility, technological advancements, regulatory and environmental risks, financial and operational risks, and geopolitical risks, investors can make informed decisions and build a resilient portfolio. Conducting thorough research, staying informed about industry trends, and diversifying investments are key strategies for assessing and mitigating these risks in the oilfield services sector. 6.4 Investing in oilfield technology and equipment. Investing in oilfield technology and equipment can be a lucrative opportunity for investors looking to capitalize on the oil industry. As the demand for oil continues to rise, the need for advanced technology and equipment in the exploration, production, and refining processes becomes increasingly important. This section will provide an overview of the benefits and considerations of investing in oilfield technology and equipment. Understanding the importance of oilfield technology and equipment. Oilfield technology and equipment play a crucial role in the efficient and cost-effective extraction of oil reserves. Advanced technologies such as seismic imaging, drilling equipment, and production optimization tools have revolutionized the oil industry, allowing companies to access previously inaccessible reserves and maximize production output. Investing in oilfield technology and equipment offers several advantages. Firstly, it allows investors to participate in the growth of the oil industry without directly investing in oil companies or commodities. This diversification can help mitigate risks associated with fluctuations in oil prices or the performance of specific oil companies. Secondly, advancements in oilfield technology and equipment have the potential to increase the efficiency and profitability of oil operations. Companies that develop and provide innovative solutions to the oil industry can experience significant growth and generate attractive returns for investors. Evaluating oilfield technology and equipment companies. When considering investments in oilfield technology and equipment, it is essential to evaluate the companies operating in this sector. Here are some key factors to consider. Technological expertise. Assess the company's track record in developing and implementing cutting-edge technologies. Look for companies that have a strong research and development focus and a history of successful innovations. Market position. Evaluate the company's market share and competitive advantage. Companies with a strong market position and a wide customer base are more likely to withstand market fluctuations and generate consistent returns. Financial performance. Analyze the company's financial statements, including revenue growth, profitability, and cash flow. A financially stable company with a solid balance sheet is better positioned to weather economic downturns and invest in future growth. Partnerships and contracts. Consider the company's partnerships and contracts with major oil companies. These relationships can provide a steady stream of revenue and validate the company's technology and equipment. Industry outlook. Stay informed about the latest trends and developments in the oil industry. Understanding the challenges and opportunities facing the sector can help identify companies that are well positioned for future growth. Assessing risks in oilfield technology and equipment investments. Like any investment, investing in oilfield technology and equipment carries certain risks. It is crucial to be aware of these risks and take them into account when making investment decisions. Here are some common risks associated with this sector. Technological obsolescence. Rapid advancements in technology can render certain equipment or solutions obsolete. Investing in companies that continuously innovate and adapt to changing market needs can help mitigate this risk. Market volatility. The oil industry is subject to price volatility and cyclical downturns. Economic factors, geopolitical events, and changes in government policies can significantly impact the demand for oilfield technology and equipment. Competition. The oilfield technology and equipment sector is highly competitive, with numerous companies vying for market share. Investing in companies with a unique value proposition or a competitive advantage can help mitigate the risk of intense competition. Regulatory and environmental factors. The oil industry is subject to various regulations and environmental considerations. Changes in regulations or increased focus on sustainability can impact the demand for certain technologies or equipment. Project delays and cost overruns. Oilfield projects often face delays and cost overruns due to technical challenges or unforeseen circumstances. These delays can impact the revenue and profitability of companies operating in this sector. Investment strategies in oilfield technology and equipment. When investing in oilfield technology and equipment, it is essential to develop a well-thought-out investment strategy. Here are some strategies to consider. Diversification. Spread your investments across multiple companies in the oilfield technology and equipment sector. This diversification can help mitigate risks associated with individual companies or technologies. Long-term perspective. Investing in oilfield technology and equipment requires a long-term perspective. The development and adoption of new technologies often take time, and returns may not be realized immediately. Stay informed. Stay updated on industry trends, technological advancements, and regulatory changes. This knowledge will help you make informed investment decisions and identify emerging opportunities. Consider professional advice. If you are new to investing in the oilfield technology and equipment sector, consider seeking advice from financial professionals or industry experts. They can provide valuable insights and help you navigate the complexities of this sector. In conclusion, investing in oilfield technology and equipment can be a rewarding opportunity for investors looking to capitalize on the growth of the oil industry. By understanding the importance of oilfield technology, evaluating companies in this sector, assessing risks, and implementing sound investment strategies, investors can position themselves for potential long-term success in this dynamic and evolving sector. 7. Investing in oil commodities. 7.1 Understanding oil commodities. Investing in oil commodities can be an attractive option for investors looking to diversify their portfolios and potentially capitalize on the volatility of oil prices. Oil commodities refer to the physical products derived from crude oil, such as crude oil itself and refined oil products like gasoline, diesel, and heating oil. In this section, we will explore the basics of oil commodities and how investors can participate in this market. What are oil commodities? Oil commodities are tangible assets that can be bought and sold on various commodity exchanges around the world. These commodities represent the underlying physical products derived from crude oil, which is extracted from the ground and refined into different products. The most commonly traded oil commodities include crude oil. Crude oil is the unrefined form of petroleum and is the primary raw material used in the production of various refined oil products. It is traded in different grades, such as Brent crude and West Texas Intermediate (WTI) crude. Refined oil products. These are the processed forms of crude oil, including gasoline, diesel, heating oil, jet fuel, and other petroleum-based products. Refined oil products are used in transportation, heating, and various industrial applications. Why invest in oil commodities? Investing in oil commodities can offer several potential benefits to investors. Diversification. Oil commodities have historically exhibited a low correlation with other asset classes, such as stocks and bonds. Adding oil commodities to a diversified portfolio can help reduce overall portfolio risk. Inflation hedge. Oil commodities have often been considered a hedge against inflation. When inflation rises, the price of oil tends to increase, which can help protect the purchasing power of investors. Potential for profit. The volatility of oil prices can create opportunities for investors to profit from price fluctuations. By correctly predicting the direction of oil prices, investors can potentially generate significant returns. Global demand. Oil is a globally traded commodity, and its demand is driven by various factors, including economic growth, geopolitical events, and transportation needs. This global demand provides a broad market for investors to participate in. How to invest in oil commodities. There are several ways for investors to gain exposure to oil commodities. Futures contracts. One of the most direct ways to invest in oil commodities is through futures contracts. Futures contracts allow investors to buy or sell a specified quantity of oil at a predetermined price and date in the future. This method requires a high level of knowledge and expertise in commodity trading. Exchange-traded funds (ETFs). ETFs that track the performance of oil commodities provide a more accessible option for investors. These funds hold a portfolio of oil-related assets, such as futures contracts or shares of oil companies, and can be bought and sold on stock exchanges like regular stocks. Oil company stocks. Investing in oil companies is another indirect way to gain exposure to oil commodities. By purchasing shares of oil companies, investors can benefit from the performance of these companies as they explore, produce, refine, and market oil and oil products. Commodity index funds. Commodity index funds provide exposure to a basket of commodities, including oil. These funds aim to replicate the performance of a specific commodity index, allowing investors to gain diversified exposure to the commodity market. Physical oil. For sophisticated investors, it is possible to invest directly in physical oil. This involves purchasing and storing barrels of oil, which requires significant logistical considerations and storage facilities. Before investing in oil commodities, it is essential to conduct thorough research and understand the risks involved. The price of oil can be highly volatile and influenced by various factors, including global supply and demand dynamics, geopolitical events, and economic conditions. Additionally, investors should consider their risk tolerance, investment goals, and time horizon before allocating capital to oil commodities. In conclusion, investing in oil commodities can provide diversification, potential for profit, and a hedge against inflation. Investors can participate in the oil market through futures contracts, ETFs, oil company stocks, commodity index funds, or even physical oil. However, it is crucial to carefully assess the risks and conduct thorough research before making any investment decisions in the oil commodities market. 7.2 Investing in crude oil. Investing in crude oil can be an attractive option for investors looking to diversify their portfolio and take advantage of the potential returns offered by the oil market. Crude oil is a highly sought-after commodity that plays a crucial role in the global economy. In this section, we will explore the various ways you can invest in crude oil and the factors to consider before making your investment. Understanding crude oil. Before diving into the investment opportunities, it is essential to have a basic understanding of what crude oil is and how it is traded. Crude oil is a naturally occurring fossil fuel that is extracted from the ground. It is a primary source of energy and is used in various industries, including transportation, manufacturing, and heating. Crude oil is traded on commodity exchanges, such as the New York Mercantile Exchange, NYMEX, and the Intercontinental Exchange, ICE. The price of crude oil is influenced by several factors, including supply and demand dynamics, geopolitical events, and global economic conditions. Investing in crude oil futures. One of the most direct ways to invest in crude oil is through futures contracts. A futures contract is an agreement to buy or sell a specific quantity of crude oil at a predetermined price and date in the future. Investing in crude oil futures allows investors to speculate on the future price movements of oil. However, investing in crude oil futures requires a high level of knowledge and expertise, as it involves trading on margin and understanding the intricacies of the futures market. It is a highly volatile investment option and may not be suitable for all investors. Investing in crude oil ETFs. For investors looking for a more accessible and diversified approach to investing in crude oil, exchange-traded funds (ETFs) can be an excellent option. Crude oil ETFs are investment funds that track the performance of crude oil prices or oil-related indexes. Investing in crude oil ETFs provides investors with exposure to the oil market without the need to directly trade futures contracts. These ETFs can be bought and sold on stock exchanges, making them more accessible to individual investors. However, it is essential to research and choose ETFs that align with your investment goals and risk tolerance. Investing in crude oil stocks. Investing in crude oil stocks is another way to gain exposure to the oil market. Crude oil stocks are shares of companies involved in the exploration, production, refining, and distribution of crude oil. These companies can range from large multinational corporations to smaller independent oil producers. When investing in crude oil stocks, it is crucial to conduct thorough research and analysis of the companies you are considering. Factors to consider include the company's financial health, management team, oil reserves, and production capabilities. Investing in individual stocks carries specific risks, such as company-specific factors and market volatility. Investing in crude oil mutual funds. Crude oil mutual funds pool money from multiple investors to invest in a diversified portfolio of crude oil-related assets. These funds are managed by professional fund managers who make investment decisions on behalf of the investors. Investing in crude oil mutual funds can provide investors with diversification and professional management. However, it is essential to carefully review the fund's investment strategy, fees, and historical performance before making an investment decision. Factors to consider. Before investing in crude oil, there are several factors to consider to make informed investment decisions. Risk tolerance. Investing in crude oil can be volatile and subject to various risks. Assess your risk tolerance and determine the level of risk you are comfortable with. Market analysis. Stay informed about the global oil market and factors that influence crude oil prices. Monitor supply and demand dynamics, geopolitical events, and economic indicators. Diversification. Consider diversifying your portfolio by investing in a mix of crude oil investments, such as futures, ETFs, stocks, and mutual funds. Diversification can help mitigate risk and maximize potential returns. Investment horizon. Determine your investment horizon and align your investment strategy accordingly. Crude oil investments can be short-term or long-term, depending on your financial goals. Research and due diligence. Conduct thorough research and analysis before making any investment decisions. Understand the fundamentals of the companies or funds you are considering and evaluate their historical performance. Consult with professionals. Consider seeking advice from financial advisors or professionals with expertise in the oil industry. They can provide valuable insights and help you make informed investment decisions. Investing in crude oil can be a lucrative opportunity for investors who are willing to understand the market dynamics and carefully evaluate their investment options. By diversifying your portfolio and staying informed about the oil market, you can position yourself for potential returns in the ever-evolving energy sector. 7.3 Investing in refined oil products. Investing in refined oil products can be an attractive option for investors looking to diversify their portfolio and take advantage of the global demand for energy. Refined oil products, also known as downstream products, are derived from crude oil through the refining process. These products include gasoline, diesel, jet fuel, heating oil, and various petrochemicals. Investing in refined oil products offers several advantages. Firstly, it allows investors to participate in the entire oil value chain, from extraction to refining and distribution. This can provide a more comprehensive exposure to the energy sector and potentially mitigate risks associated with fluctuations in crude oil prices. Additionally, refined oil products have a wide range of applications across various industries, making them a crucial component of the global economy. There are several ways to invest in refined oil products, each with its own set of advantages and considerations. Here are some common investment options. Oil refining companies. Investing in companies engaged in oil refining can be a direct way to gain exposure to the refined oil products market. These companies operate refineries that process crude oil into various products. When evaluating oil refining companies, it is important to consider factors such as their refining capacity, operational efficiency, and geographic diversification. Additionally, analyzing their financial performance and management expertise can provide insights into their long-term growth potential. Exchange-traded funds (ETFs). ETFs offer a convenient way to invest in a diversified portfolio of companies involved in the refining and marketing of oil products. These funds typically track an index composed of oil refining companies, providing investors with exposure to the overall performance of the sector. ETFs can be bought and sold on stock exchanges, offering liquidity and flexibility to investors. Oil refining and marketing mutual funds. Mutual funds focused on the oil refining and marketing sector can provide investors with a diversified portfolio of companies involved in the production, refining, and distribution of refined oil products. These funds are managed by professional fund managers who conduct in-depth research and analysis to identify potential investment opportunities. Investing in mutual funds can be suitable for investors seeking a more passive approach to refined oil product investments. Futures and options contracts. For more experienced investors, futures and options contracts can be used to speculate on the price movements of refined oil products. These derivative instruments allow investors to take both long and short positions on the underlying commodities. However, trading futures and options contracts requires a deep understanding of the market dynamics and can involve significant risks, including the potential for substantial losses. When investing in refined oil products, it is important to consider the risks associated with this sector. Some key risks include price volatility. Refined oil product prices can be highly volatile, influenced by factors such as global demand, geopolitical events, and changes in refining capacity. Investors should be prepared for price fluctuations and have a risk management strategy in place. Regulatory and environmental risks. The refining industry is subject to various regulations and environmental standards. Changes in regulations or the introduction of new environmental policies can impact the profitability and operations of oil refining companies. Competition and market dynamics. The refined oil products market is highly competitive, with numerous players vying for market share. Investors should carefully evaluate the competitive landscape and the ability of companies to adapt to changing market dynamics. Geopolitical risks. Political instability, conflicts, and sanctions in oil-producing regions can disrupt the supply chain and impact the availability and pricing of refined oil products. Investors should stay informed about geopolitical developments and their potential impact on the market. In conclusion, investing in refined oil products can provide investors with exposure to the global energy sector and the potential for attractive returns. Whether through direct investments in oil refining companies, ETFs, mutual funds, or derivative instruments, investors should carefully evaluate the risks and opportunities associated with this sector. Conducting thorough research, diversifying investments, and staying informed about market trends and developments are essential for successful investing in refined oil products. 7.4 Assessing oil commodities risks. Investing in oil commodities can be a lucrative venture, but it is not without its risks. As with any investment, it is important to thoroughly assess the risks involved before committing your capital. In this section, we will explore some of the key risks associated with investing in oil commodities. Market volatility. One of the primary risks of investing in oil commodities is market volatility. Oil prices can be highly volatile, influenced by a multitude of factors such as geopolitical tensions, supply and demand dynamics, and global economic conditions. These fluctuations can lead to significant price swings, making it challenging to predict and time your investments accurately. To mitigate this risk, it is crucial to stay informed about the factors that impact oil prices. Keep a close eye on global events, such as political developments in oil-producing regions, changes in oil production levels, and shifts in consumer demand. Additionally, consider diversifying your portfolio to include other assets that are not directly correlated with oil prices. This can help offset potential losses during periods of oil price volatility. Geopolitical risks. Investing in oil commodities also exposes you to geopolitical risks. Oil-producing regions are often located in politically unstable areas, prone to conflicts, sanctions, and regulatory changes. These geopolitical factors can disrupt oil production and supply, leading to price fluctuations and potential investment losses. To assess geopolitical risks, stay informed about the political climate in major oil-producing countries and regions. Monitor news and developments related to international relations, trade agreements, and sanctions. Additionally, consider diversifying your oil investments across different regions to minimize the impact of geopolitical events on your portfolio. Supply and demand imbalances. Another risk to consider when investing in oil commodities is supply and demand imbalances. Fluctuations in global oil production and consumption can create imbalances that impact oil prices. For example, if there is an oversupply of oil due to increased production or decreased demand, prices may decline. Conversely, if there is a shortage of oil due to production disruptions or increased demand, prices may rise. To assess supply and demand risks, closely monitor global oil production levels, consumption patterns, and industry forecasts. Stay informed about major oil producers and their production capabilities, as well as emerging trends in energy consumption. This information can help you anticipate potential imbalances and make informed investment decisions. Environmental and regulatory risks. Investing in oil commodities also carries environmental and regulatory risks. The oil industry is subject to various environmental regulations aimed at reducing carbon emissions and promoting sustainable energy sources. These regulations can impact the profitability and operations of oil companies, potentially affecting the value of your investments. To assess environmental and regulatory risks, stay informed about evolving environmental policies and regulations. Monitor developments related to renewable energy initiatives, carbon pricing mechanisms, and international agreements aimed at reducing greenhouse gas emissions. Additionally, consider diversifying your portfolio to include investments in renewable energy companies, which can help mitigate the impact of environmental and regulatory risks on your overall investment performance. Currency risks. Investing in oil commodities can expose you to currency risks. Oil prices are typically denominated in US dollars, so fluctuations in currency exchange rates can impact the value of your investments. If the value of the US dollar strengthens against other currencies, it can lead to lower oil prices in those currencies, potentially affecting your returns. To assess currency risks, monitor exchange rates and stay informed about global economic conditions. Consider diversifying your portfolio to include investments in different currencies or currency-hedged oil funds, which can help mitigate the impact of currency fluctuations on your investments. Conclusion. Investing in oil commodities can be a profitable venture, but it is essential to assess the risks involved. Market volatility, geopolitical risks, supply and demand imbalances, environmental and regulatory risks, and currency risks are some of the key factors to consider. By staying informed, diversifying your portfolio, and carefully monitoring these risks, you can make more informed investment decisions and navigate the complexities of the oil commodities market. 8. Investing in renewable energy. 8.1 The rise of renewable energy. Renewable energy has emerged as a significant player in the global energy landscape, presenting new opportunities for investors. As concerns about climate change and the finite nature of fossil fuels continue to grow, governments, businesses, and individuals are increasingly turning to renewable energy sources as a sustainable and environmentally friendly alternative. This shift towards renewable energy has created a promising investment landscape for those looking to diversify their portfolios and capitalize on the growing demand for clean energy solutions. The growing importance of renewable energy. Renewable energy sources, such as solar, wind, hydro, geothermal, and biomass, have gained traction in recent years due to several factors. First and foremost, the environmental benefits of renewable energy are undeniable. Unlike fossil fuels, renewable energy sources produce little to no greenhouse gas emissions, reducing the carbon footprint and mitigating the effects of climate change. This has led to increased government support and favorable policies aimed at promoting the adoption of renewable energy technologies. Furthermore, advancements in technology and economies of scale have significantly reduced the cost of renewable energy production. Solar and wind energy, in particular, have become increasingly competitive with traditional fossil fuel-based power generation. As a result, renewable energy projects have become more economically viable, attracting substantial investments from both public and private sectors. Investment opportunities in renewable energy companies. Investing in renewable energy companies can provide investors with exposure to this rapidly growing sector. There are several avenues through which individuals can invest in renewable energy, including renewable energy stocks. Investing in publicly traded renewable energy companies allows investors to participate in the growth of the sector. These companies are involved in various aspects of the renewable energy value chain, including manufacturing, project development, and operation. When selecting renewable energy stocks, it is essential to consider factors such as the company's financial health, technological expertise, and market position. Renewable Energy Exchange-Traded Funds (ETFs). ETFs offer a diversified approach to investing in renewable energy. These funds typically hold a basket of renewable energy stocks, providing investors with exposure to multiple companies within the sector. ETFs can be an attractive option for those looking for a more diversified investment strategy or who may not have the time or expertise to research individual companies. Renewable Energy Infrastructure Funds. Infrastructure funds focus on investing in renewable energy projects, such as solar farms, wind farms, and hydroelectric plants. These funds provide investors with the opportunity to participate in the long-term cash flows generated by these projects. Infrastructure funds often offer stable income streams and can be an attractive option for income-oriented investors. Venture capital and private equity. Investing in renewable energy startups and early-stage companies can offer significant growth potential. However, these investments also come with higher risks. Venture capital and private equity firms typically invest in companies developing innovative technologies or business models within the renewable energy sector. Assessing risks and opportunities in renewable energy. While renewable energy presents exciting investment opportunities, it is essential to understand the risks associated with this sector. Some key considerations include regulatory and policy risks. Government policies and regulations play a crucial role in shaping the renewable energy market. Changes in policies, subsidies, or incentives can impact the profitability of renewable energy projects and companies. Investors should stay informed about the regulatory environment and assess the potential impact on their investments. Technological advancements. The renewable energy sector is constantly evolving, with new technologies and innovations emerging regularly. Investing in companies with a strong focus on research and development can help mitigate the risk of technological obsolescence. Market volatility. Like any investment, the renewable energy sector is subject to market fluctuations. Factors such as changes in energy prices, economic conditions, and investor sentiment can impact the performance of renewable energy stocks and funds. Competition and market dynamics. The renewable energy sector is becoming increasingly competitive as more companies enter the market. Investors should carefully evaluate the competitive landscape and consider factors such as market share, differentiation, and barriers to entry when selecting investments. Despite these risks, the long-term outlook for renewable energy remains positive. As the world continues to transition towards a low-carbon economy, the demand for renewable energy is expected to grow significantly. This growth presents opportunities for investors to participate in the development and expansion of renewable energy infrastructure and technologies. In conclusion, the rise of renewable energy has opened up new avenues for investment. By investing in renewable energy companies, individuals can align their portfolios with their environmental values while potentially benefiting from the sector's growth. However, it is crucial to conduct thorough research, assess risks, and diversify investments to maximize the potential returns in this evolving and dynamic sector. 8.2 Investing in renewable energy companies. Investing in renewable energy companies can be a lucrative and socially responsible way to diversify your investment portfolio. As the world shifts towards cleaner and more sustainable energy sources, renewable energy companies are experiencing significant growth and offer attractive investment opportunities. In this section, we will explore the various aspects of investing in renewable energy companies and provide you with valuable insights to help you make informed investment decisions. Understanding the renewable energy sector. Before diving into the specifics of investing in renewable energy companies, it is essential to have a solid understanding of the sector as a whole. Renewable energy refers to energy derived from natural resources that are replenished at a faster rate than they are consumed. These resources include solar power, wind power, hydroelectric power, geothermal energy, and biomass. The renewable energy sector has experienced remarkable growth in recent years, driven by increasing concerns about climate change, government incentives, and advancements in technology. As a result, renewable energy companies have become key players in the global energy landscape, offering innovative solutions to meet the world's growing energy demands while reducing carbon emissions. Evaluating renewable energy companies. When considering investing in renewable energy companies, it is crucial to conduct thorough research and evaluation. Here are some key factors to consider. Financial performance. Assess the financial health and stability of the company by analyzing its revenue growth, profitability, and cash flow. Look for companies with a strong track record of financial performance and a solid balance sheet. Technological advancements. Evaluate the company's technological capabilities and its ability to innovate and adapt to changing market trends. Companies that invest in research and development and stay at the forefront of technological advancements are more likely to succeed in the long run. Market position. Consider the company's market position and competitive advantage. Look for companies with a strong market presence, a diversified customer base, and a solid reputation within the industry. Management team. Assess the expertise and experience of the company's management team. Look for a team with a proven track record in the renewable energy sector and a clear vision for the company's future growth. Regulatory environment. Understand the regulatory environment in which the company operates. Government policies and regulations can significantly impact the growth and profitability of renewable energy companies. Look for companies operating in regions with supportive policies and incentives for renewable energy. Environmental impact. Consider the company's commitment to sustainability and its environmental impact. Look for companies that prioritize environmental stewardship and have a strong focus on reducing carbon emissions. Types of renewable energy companies. There are various types of renewable energy companies that you can invest in, each with its own unique characteristics and investment opportunities. Here are some common types. Solar energy companies. These companies focus on harnessing the power of the sun to generate electricity. They may be involved in the manufacturing of solar panels, installation of solar systems, or development of solar power plants. Wind energy companies. These companies specialize in harnessing wind power to generate electricity. They may be involved in the manufacturing of wind turbines, development of wind farms, or operation and maintenance of wind power facilities. Hydroelectric power companies. These companies generate electricity by harnessing the power of flowing or falling water. They may own and operate hydroelectric power plants or provide equipment and services to the hydroelectric industry. Geothermal energy companies. These companies focus on harnessing the heat from the Earth's core to generate electricity. They may be involved in the development and operation of geothermal power plants or the exploration and extraction of geothermal resources. Biomass energy companies. These companies utilize organic materials, such as agricultural waste or wood pellets, to generate heat or electricity. They may be involved in the production and distribution of biomass fuels or the operation of biomass power plants. Risks and opportunities in renewable energy investing. Like any investment, investing in renewable energy companies comes with its own set of risks and opportunities. Here are some key considerations. Volatility. The renewable energy sector can be volatile, influenced by factors such as government policies, changes in energy prices, and technological advancements. It is important to be prepared for potential fluctuations in stock prices and market conditions. Regulatory changes. Changes in government policies and regulations can significantly impact the profitability and growth prospects of renewable energy companies. Stay informed about the regulatory environment and be prepared to adapt your investment strategy accordingly. Competition. The renewable energy sector is becoming increasingly competitive as more companies enter the market. Look for companies with a competitive advantage, such as proprietary technology or strong brand recognition, to mitigate the risks associated with intense competition. Technological advancements. Technological advancements can both create opportunities and pose risks in the renewable energy sector. Stay updated on the latest developments and invest in companies that have a proven ability to innovate and adapt to changing market trends. Global energy transition. The ongoing global transition towards renewable energy presents significant opportunities for investors. As governments and businesses worldwide commit to reducing carbon emissions, renewable energy companies are likely to benefit from increased demand and market growth. Conclusion. Investing in renewable energy companies can be a rewarding and socially responsible way to diversify your investment portfolio. By understanding the renewable energy sector, evaluating companies effectively, and considering the risks and opportunities, you can make informed investment decisions that align with your financial goals and values. As the world continues to prioritize sustainability and clean energy, renewable energy companies are poised for long-term growth and offer exciting investment prospects. To invest in oil, there are several options available to you. Here are some common ways to invest in oil. Oil stocks. Investing in oil company stocks is a popular way to gain exposure to the oil industry. You can buy shares of publicly traded oil companies, such as ExxonMobil or Chevron. When investing in oil stocks, it's important to research the financial health and performance of the company, as well as factors that may impact oil prices. Oil ETFs. Exchange-traded funds (ETFs) are investment funds that trade on stock exchanges. There are ETFs specifically focused on the oil industry, which allow you to invest in a diversified portfolio of oil-related assets. These ETFs may include stocks of oil companies, futures contracts, or other oil-related investments. Oil futures and options. Futures and options contracts allow investors to speculate on the future price of oil. With futures contracts, you agree to buy or sell a certain amount of oil at a predetermined price and date in the future. Options contracts give you the right, but not the obligation, to buy or sell oil at a specific price within a certain time frame. Oil mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of assets, including oil-related investments. These funds are managed by professional fund managers who make investment decisions on behalf of the investors. Investing in oil mutual funds can provide exposure to a variety of oil-related assets, such as stocks, bonds, and derivatives. Oil exploration and production companies. Another way to invest in oil is by directly investing in oil exploration and production companies. These companies are involved in the process of finding and extracting oil from the ground. Investing in these companies can be more volatile and risky compared to investing in larger, more established oil companies. Oil refining and marketing companies. Investing in oil refining and marketing companies allows you to gain exposure to the downstream sector of the oil industry. These companies are involved in refining crude oil into various petroleum products, such as gasoline, diesel, and jet fuel. They also distribute and market these products to consumers. Oilfield services companies. Oilfield services companies provide various services and equipment to the oil industry, such as drilling, well maintenance, and equipment rental. Investing in these companies can be a way to indirectly participate in the oil industry by supporting the operations of oil exploration and production companies. Oil commodities. Investing in oil commodities involves buying and selling physical barrels of oil. This can be done through commodity exchanges or through specialized oil trading platforms. Investing in oil commodities requires knowledge of the oil market and the ability to monitor and analyze supply and demand factors. When investing in oil, it's important to consider the risks involved. Oil prices can be volatile and are influenced by various factors, such as geopolitical events, economic conditions, and supply and demand dynamics. It's also important to diversify your investments and consider your risk tolerance and investment goals. Before making any investment decisions, it's recommended to do thorough research, consult with a financial advisor, and consider your own financial situation and investment objectives. 8.4 The future of oil and renewable energy. As the world continues to grapple with the challenges of climate change and the need for sustainable energy sources, the future of oil investing is becoming increasingly uncertain. The global shift towards renewable energy is gaining momentum, and this has significant implications for the oil industry and those looking to invest in it. The rise of renewable energy. Renewable energy sources, such as solar, wind, and hydroelectric power, have been growing in popularity and affordability over the past decade. This shift is driven by a combination of factors, including concerns about climate change, government incentives, and advancements in technology. As a result, renewable energy has become a viable and attractive alternative to traditional fossil fuels. Investing in renewable energy companies. Investors who are interested in the future of energy may consider investing in renewable energy companies. These companies are involved in the development, production, and distribution of renewable energy technologies and solutions. By investing in these companies, investors can support the growth of clean energy and potentially benefit from the sector's expansion. Assessing risks and opportunities in renewable energy. While renewable energy presents exciting opportunities for investors, it is not without its risks. As with any investment, it is crucial to conduct thorough research and due diligence before committing capital. Some of the risks associated with renewable energy investing include technological advancements, government policies, and market competition. However, the potential for long-term growth and the positive environmental impact make it an attractive investment option for many. The future of oil investing. The future of oil investing is closely tied to the ongoing transition towards renewable energy. While oil will likely remain a significant energy source for the foreseeable future, its dominance may gradually diminish as renewable energy becomes more prevalent. Here are some key factors to consider when assessing the future of oil investing. Demand and consumption patterns. The demand for oil is influenced by various factors, including economic growth, population growth, and transportation needs. As countries and industries adopt renewable energy alternatives, the demand for oil may decline. However, it is important to note that oil will likely continue to play a crucial role in certain sectors, such as aviation and heavy industry, where viable renewable alternatives are still under development. Technological advancements. The oil industry has a long history of technological advancements, and this trend is expected to continue. New technologies, such as enhanced oil recovery techniques and advanced drilling methods, can increase the efficiency of oil extraction and production. These advancements may help oil companies remain competitive and profitable in a changing energy landscape. Environmental and sustainability considerations. The environmental impact of oil extraction and consumption is a significant concern. As governments and societies become more focused on sustainability, stricter regulations and policies may be implemented to reduce carbon emissions and promote cleaner energy sources. These factors can affect the profitability and viability of oil investments. Geopolitical factors. Oil has long been a driver of geopolitical dynamics, with countries vying for control over resources and using oil as a tool of influence. As the world transitions to renewable energy, the geopolitical landscape may shift, potentially impacting oil prices and investment opportunities. It is essential for investors to stay informed about geopolitical developments and their potential impact on the oil market. Diversification and adaptation. As the future of oil becomes more uncertain, investors may consider diversifying their portfolios to include a mix of energy sources, including renewable energy. Diversification can help mitigate risks and take advantage of emerging opportunities in the energy sector. Additionally, oil companies themselves may adapt their business models to incorporate renewable energy technologies and diversify their operations. In conclusion, the future of oil investing is undoubtedly influenced by the rise of renewable energy. While oil will likely remain a significant energy source, the increasing focus on sustainability and the growth of renewable energy present both challenges and opportunities for investors. By staying informed, conducting thorough research, and considering the evolving energy landscape, investors can make informed decisions about their oil investments and position themselves for long-term success. 9. Managing risks in oil investing. To invest in oil, there are several strategies and options available to investors. Here are some common ways to invest in oil. Oil stocks. Investing in oil company stocks is one of the most popular ways to gain exposure to the oil industry. This involves buying shares of publicly traded oil companies, such as major integrated oil companies or smaller exploration and production companies. When investing in oil stocks, it is important to research and analyze the financial health, management, and growth prospects of the companies before making investment decisions. Oil ETFs. Exchange-traded funds (ETFs) are investment funds that trade on stock exchanges, and they can provide exposure to the oil industry. Oil ETFs typically track the performance of oil-related indexes or invest in a portfolio of oil-related assets. Investing in oil ETFs allows investors to gain exposure to the oil industry without directly owning individual stocks. Oil futures and options. Futures and options contracts are derivatives that allow investors to speculate on the future price of oil. These contracts provide the right or obligation to buy or sell oil at a predetermined price and date in the future. Futures and options trading requires a good understanding of the oil market and can be more complex and risky compared to other investment options. Oil mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of oil-related securities. These funds are managed by professional fund managers who make investment decisions on behalf of the investors. Investing in oil mutual funds can provide diversification and professional management, but it is important to carefully evaluate the fund's performance, fees, and investment strategy. Oil exploration and production companies. Investing directly in oil exploration and production companies involves purchasing shares of companies involved in finding and extracting oil reserves. These companies can be highly volatile and are exposed to risks such as fluctuating oil prices, regulatory changes, and geopolitical factors. It is crucial to conduct thorough research and analysis before investing in individual exploration and production companies. Oil refining and marketing companies. Another way to invest in the oil industry is by investing in companies involved in the refining and marketing of oil products. These companies process crude oil into refined products such as gasoline, diesel, and jet fuel, and distribute them to consumers. Investing in refining and marketing companies can provide exposure to different segments of the oil industry and can be less volatile compared to exploration and production companies. Oilfield services companies. Oilfield services companies provide various services and equipment to support oil exploration, production, and transportation activities. Investing in these companies can provide exposure to the oil industry without the direct risks associated with oil price fluctuations. However, it is important to evaluate the financial health, competitive position, and growth prospects of these companies before investing. Oil commodities. Investing in oil commodities involves buying and selling physical barrels of oil or oil-related products. This can be done through commodity exchanges or specialized trading platforms. Investing in oil commodities requires a good understanding of the oil market, supply and demand dynamics, and price trends. When investing in oil, it is important to consider diversification strategies to manage risks. Diversification involves spreading investments across different types of oil-related assets, such as stocks, ETFs, and commodities, as well as different companies and sectors within the oil industry. This helps to reduce the impact of any single investment on the overall portfolio performance. Diversification can be achieved by investing in a mix of oil-related assets, including both upstream exploration and production and downstream refining and marketing companies. It is also important to consider investing in other sectors and asset classes to further diversify the portfolio and reduce exposure to the risks specific to the oil industry. Additionally, diversification can be achieved by investing in oil companies operating in different regions or countries. This helps to mitigate the risks associated with geopolitical factors, regulatory changes, and regional economic conditions that can impact the oil industry. Investors should also consider the size and liquidity of their investments. Investing in large, well-established oil companies with a proven track record can provide stability and liquidity. However, smaller companies or emerging market investments may offer higher growth potential but can be riskier and less liquid. It is important to regularly review and rebalance the portfolio to ensure that the diversification strategy is maintained. This involves monitoring the performance of individual investments, assessing the changing market conditions, and making adjustments as needed. In conclusion, diversification is a key strategy for managing risks in oil investing. By spreading investments across different types of oil-related assets, sectors, regions, and company sizes, investors can reduce the impact of any single investment on their overall portfolio. However, it is important to conduct thorough research and analysis before making investment decisions and to regularly review and adjust the portfolio to maintain the desired diversification strategy. 9.2 Hedging Techniques. Hedging is a risk management strategy that investors use to protect themselves against potential losses in the oil market. It involves taking offsetting positions in related assets to minimize the impact of price fluctuations. Hedging techniques can be valuable tools for oil investors, allowing them to mitigate risk and safeguard their investments. In this section, we will explore some common hedging techniques used in oil investing. Futures contracts. One of the most popular hedging techniques in the oil market is the use of futures contracts. A futures contract is an agreement to buy or sell a specific quantity of oil at a predetermined price and date in the future. By entering into a futures contract, investors can lock in the price of oil, protecting themselves from potential price fluctuations. For example, if an investor expects the price of oil to increase in the future, they can buy a futures contract at the current price. If the price of oil does indeed rise, the investor can sell the futures contract at a profit, offsetting any losses in their physical oil investments. On the other hand, if the price of oil decreases, the investor can still sell the physical oil at a higher price, thanks to the futures contract. Options contracts. Options contracts are another hedging technique commonly used in oil investing. Unlike futures contracts, options contracts provide the investor with the right, but not the obligation, to buy or sell oil at a predetermined price and date. This flexibility allows investors to protect themselves against potential losses while still benefiting from favorable price movements. There are two types of options contracts: call options and put options. A call option gives the investor the right to buy oil at a specified price, while a put option gives the investor the right to sell oil at a specified price. By purchasing options contracts, investors can limit their downside risk while still participating in the potential upside of the oil market. For instance, if an investor holds physical oil and expects the price to decline, they can purchase put options to sell oil at a predetermined price. If the price does indeed decrease, the investor can exercise the put options and sell their oil at the higher price, offsetting any losses in their physical oil investments. Conversely, if the price of oil increases, the investor can still sell the physical oil at a higher price, foregoing the option to sell at the predetermined price. Exchange-traded funds (ETFs). Exchange-traded funds (ETFs) are investment funds that trade on stock exchanges, representing a basket of assets such as stocks, bonds, or commodities. In the case of oil investing, there are ETFs that track the performance of oil prices. These ETFs can be used as a hedging tool by investors looking to protect themselves against oil price fluctuations. By investing in oil ETFs, investors can gain exposure to the oil market without directly owning physical oil. This allows them to hedge their positions by taking short positions in oil ETFs when they expect the price of oil to decline. If the price does indeed decrease, the investor can profit from the decline in the value of the ETF, offsetting any losses in their physical oil investments. Swaps. Swaps are another hedging technique used in oil investing. A swap is an agreement between two parties to exchange cash flows based on the price of oil. In an oil swap, one party agrees to pay the other party the difference between the current price of oil and a predetermined price at a specified future date. Swaps can be used by investors to hedge against price fluctuations in the oil market. For example, if an investor expects the price of oil to decrease, they can enter into a swap agreement to receive payments if the price does indeed decline. These payments can help offset any losses in their physical oil investments. Hedging strategies. When implementing hedging techniques, it is important for investors to develop a clear hedging strategy. This involves determining the appropriate hedging instruments to use, the desired level of protection, and the timing of the hedge. Hedging strategies can vary depending on an investor's risk tolerance, investment goals, and market outlook. It is also crucial for investors to regularly monitor and adjust their hedging positions as market conditions change. Hedging is not a one-time event but an ongoing process that requires active management. By staying informed about market trends and adjusting their hedging positions accordingly, investors can effectively manage risk and protect their oil investments. In conclusion, hedging techniques are valuable tools for oil investors to manage risk and protect their investments. Futures contracts, options contracts, ETFs, and swaps are commonly used hedging instruments in the oil market. By implementing a well-defined hedging strategy and regularly monitoring their positions, investors can mitigate the impact of price fluctuations and safeguard their oil investments. 9.3 Managing price volatility. Investing in oil can be a lucrative venture, but it also comes with its fair share of risks. One of the most significant challenges that oil investors face is price volatility. Oil prices can fluctuate dramatically due to various factors such as supply and demand dynamics, geopolitical tensions, economic conditions, and even weather events. As an oil investor, it is crucial to understand and manage price volatility effectively to protect your investments and maximize returns. In this section, we will explore some strategies to help you manage price volatility in oil investing. 1. Stay informed and monitor market trends. To effectively manage price volatility, it is essential to stay informed about the latest developments in the oil market. Keep track of industry news, market trends, and economic indicators that can impact oil prices. Stay updated on geopolitical events, production levels, inventories, and demand forecasts. By staying informed, you can anticipate potential price movements and make informed investment decisions. 2. Diversify your portfolio. Diversification is a fundamental risk management strategy in any investment portfolio, including oil investing. By diversifying your investments across different sectors and asset classes, you can reduce the impact of price volatility on your overall portfolio. Consider investing in a mix of oil-related assets such as oil stocks, ETFs, futures, and options, as well as other non-oil investments. Diversification helps spread the risk and can provide a cushion against significant price fluctuations in any single investment. 3. Use stop-loss orders. Stop-loss orders are a risk management tool that can help protect your investments from severe price declines. A stop-loss order is an instruction to sell a security if it reaches a predetermined price level. By setting a stop-loss order, you can limit your potential losses if oil prices suddenly drop. It is important to determine an appropriate stop-loss level based on your risk tolerance and investment objectives. 4. Consider dollar cost averaging. Dollar cost averaging is an investment strategy that involves investing a fixed amount of money at regular intervals, regardless of the asset's price. This strategy can be useful in managing price volatility because it allows you to buy more shares when prices are low and fewer shares when prices are high. Over time, this approach can help smooth out the impact of price fluctuations and potentially lower your average cost per share. 5. Utilize hedging techniques. Hedging is a risk management strategy that involves taking offsetting positions to protect against adverse price movements. In the context of oil investing, you can use hedging techniques to mitigate the impact of price volatility. For example, you can enter into futures contracts to lock in a specific price for future oil deliveries. This can help protect your investments from potential price declines. However, it is important to note that hedging involves additional costs and complexities, so it is advisable to seek professional advice before implementing hedging strategies. 6. Consider long-term investing. Price volatility in the oil market is often driven by short-term factors and can be unpredictable in the short term. However, over the long term, oil prices tend to reflect supply and demand fundamentals. By taking a long-term investment approach, you can potentially ride out short-term price fluctuations and benefit from the overall growth in the oil industry. Long-term investing allows you to focus on the underlying value of your investments rather than getting caught up in short-term market noise. 7. Evaluate risk-reward ratio. Before making any investment decisions, it is crucial to evaluate the risk-reward ratio. Assess the potential risks associated with investing in oil and compare them to the potential rewards. Consider factors such as the current oil price environment, market conditions, and your risk tolerance. Understanding the risk-reward dynamics can help you make more informed investment choices and manage price volatility effectively. 8. Seek professional advice. Managing price volatility in oil investing can be complex, and it is always advisable to seek professional advice. Consult with financial advisors, brokers, or investment professionals who specialize in the oil industry. They can provide valuable insights, help you navigate the complexities of the market, and develop a customized investment strategy based on your goals and risk tolerance. In conclusion, managing price volatility is a critical aspect of successful oil investing. By staying informed, diversifying your portfolio, using risk management tools, and seeking professional advice, you can effectively navigate the challenges posed by price fluctuations. Remember that oil prices can be influenced by various factors, and it is important to develop a well-rounded investment strategy that aligns with your financial goals and risk tolerance. 9.4 Political and geopolitical risks. Political and geopolitical risks play a significant role in the oil industry and can have a substantial impact on oil prices and investments. These risks arise from various factors, including political instability, conflicts, sanctions, and changes in government policies. As an oil investor, it is crucial to understand and manage these risks effectively to protect your investments and maximize returns. Political instability. Political instability in oil-producing countries can disrupt oil production and supply, leading to price volatility in the global oil market. Factors such as civil unrest, regime changes, and political conflicts can create uncertainties and hinder the smooth operation of oil companies. For example, protests or strikes by workers in oil fields can disrupt production, causing a temporary shortage in supply and driving up prices. Investors should closely monitor the political situation in major oil-producing countries such as Saudi Arabia, Iraq, Iran, Venezuela, and Nigeria. Any significant political developments in these countries can have a direct impact on oil prices and investment opportunities. It is essential to stay informed about the political landscape and assess the potential risks associated with investing in these regions. Geopolitical conflicts. Geopolitical conflicts, such as wars or territorial disputes, can have a profound impact on oil investments. These conflicts can disrupt oil transportation routes, damage infrastructure, and create uncertainties in the market. For example, tensions in the Middle East, particularly in the Persian Gulf region, have historically led to oil price spikes due to concerns over supply disruptions. Investors should consider the geopolitical risks associated with investing in regions prone to conflicts. It is crucial to assess the stability of the region and evaluate the potential impact of any ongoing or potential conflicts on oil prices and investments. Geopolitical risks can be challenging to predict, but staying informed about global events and geopolitical dynamics can help investors make more informed decisions. Sanctions and trade policies. Sanctions imposed by governments on oil-producing countries can significantly impact oil investments. These sanctions can restrict or prohibit trade, leading to reduced oil supply and increased prices. For example, sanctions imposed on Iran in the past have limited its ability to export oil, resulting in a decrease in global supply. Investors should closely monitor international trade policies and sanctions imposed on oil-producing countries. Changes in trade policies, such as tariffs or embargoes, can disrupt the flow of oil and affect investment opportunities. It is essential to assess the potential impact of sanctions and trade policies on oil prices and investments and adjust your investment strategy accordingly. Government policies and regulations. Government policies and regulations can also pose risks to oil investments. Changes in taxation, environmental regulations, or energy policies can impact the profitability of oil companies and influence investment decisions. For example, stricter environmental regulations may increase costs for oil companies, affecting their profitability and stock performance. Investors should stay updated on government policies and regulations related to the oil industry. Understanding the potential impact of these policies on oil companies and the overall market can help investors make informed investment decisions. It is crucial to assess the regulatory environment and consider the long-term implications of government policies on oil investments. Managing political and geopolitical risks. To manage political and geopolitical risks in oil investing, diversification and risk management strategies are essential. Diversifying your oil investments across different regions and companies can help mitigate the impact of political and geopolitical events in a specific area. By spreading your investments, you reduce the risk of a single event significantly affecting your entire portfolio. Additionally, staying informed about global political developments, geopolitical conflicts, and government policies is crucial. Regularly monitoring news and analysis from reliable sources can help you stay ahead of potential risks and make informed investment decisions. Consulting with financial advisors or experts who specialize in the oil industry can also provide valuable insights and guidance in managing political and geopolitical risks. In conclusion, political and geopolitical risks are inherent in oil investing. Understanding and managing these risks is crucial for successful oil investments. By closely monitoring political developments, geopolitical conflicts, sanctions, and government policies, investors can make informed decisions and adjust their investment strategies accordingly. Diversification and risk management strategies are essential tools to mitigate the impact of political and geopolitical risks on oil investments. 10. Tax considerations in oil investing. To invest in oil, there are several options available to you. Here are some common ways to invest in oil. Oil stocks. Investing in oil company stocks is one of the most popular ways to gain exposure to the oil industry. You can buy shares of publicly traded oil companies, such as ExxonMobil or Chevron, through a brokerage account. When you invest in oil stocks, you are essentially buying a stake in the company's future profits and growth. Oil ETFs, exchange-traded funds (ETFs), are investment funds that trade on stock exchanges, similar to individual stocks. Oil ETFs allow investors to gain exposure to the price of oil without directly owning the commodity. These funds typically invest in oil futures contracts or oil-related stocks. Examples of oil ETFs include the United States Oil Fund (USO) and the Energy Select Sector SPDR Fund (XLE). Oil futures and options. Futures and options contracts are derivatives that allow investors to speculate on the future price of oil. With futures contracts, you agree to buy or sell a specified quantity of oil at a predetermined price and date in the future. Options contracts give you the right, but not the obligation, to buy or sell oil at a specific price within a certain time frame. Trading oil futures and options requires a good understanding of the market and can be more complex than other investment options. Oil mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of securities, including oil-related assets. Oil mutual funds are managed by professional fund managers who make investment decisions on behalf of the investors. These funds can provide exposure to a variety of oil-related investments, such as oil stocks, oil ETFs, and oil futures contracts. Oil exploration and production companies. Another way to invest in oil is by directly investing in oil exploration and production (E&P) companies. These companies are involved in the discovery, extraction, and production of oil and gas reserves. Investing in E&P companies can be riskier than investing in larger, more established oil companies, but it can also offer higher potential returns. Oil refining and marketing companies. Investing in oil refining and marketing companies allows you to participate in the downstream activities of the oil industry. These companies refine crude oil into various petroleum products, such as gasoline, diesel, and jet fuel, and distribute them to consumers. Investing in refining and marketing companies can provide exposure to the demand side of the oil market. Oilfield services companies. Oilfield services companies provide various services and equipment to the oil and gas industry, such as drilling, well maintenance, and equipment rental. Investing in oilfield services companies can be a way to indirectly invest in the oil industry by supporting the companies that provide essential services to oil producers. Oil commodities. For more experienced investors, trading oil commodities directly in the futures market is an option. This involves buying and selling contracts for physical delivery of oil. However, trading oil commodities requires a deep understanding of the market and can be highly volatile. Before investing in oil, it is important to conduct thorough research and consider your risk tolerance, investment goals, and time horizon. It is also advisable to consult with a financial advisor or tax professional to understand the tax implications and any specific regulations related to oil investments in your country. To invest in oil, there are several options available to you. Here are some common ways to invest in oil. Oil stocks. Investing in oil company stocks is a popular way to gain exposure to the oil industry. You can buy shares of publicly traded oil companies, such as ExxonMobil or Chevron. When you invest in oil stocks, you are essentially buying a stake in the company's future profits and growth. It's important to research and analyze the financial health and performance of the company before making any investment decisions. Oil ETFs. Exchange-traded funds (ETFs) are investment funds that trade on stock exchanges, similar to individual stocks. Oil ETFs allow investors to gain exposure to the price of oil without directly owning the commodity. These funds typically invest in oil futures contracts or oil-related stocks. Investing in oil ETFs can provide diversification and liquidity, as they can be bought and sold throughout the trading day. Oil futures and options. Futures and options contracts are derivatives that allow investors to speculate on the future price of oil. Futures contracts obligate the buyer to purchase a specified quantity of oil at a predetermined price and date in the future. Options contracts give the buyer the right, but not the obligation, to buy or sell oil at a specific price within a certain time frame. Trading oil futures and options requires a good understanding of the market and can be more complex and risky compared to other investment options. Oil mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of securities, including oil-related assets. Oil mutual funds are managed by professional fund managers who make investment decisions on behalf of the investors. These funds can provide exposure to a broad range of oil-related investments, such as oil stocks, oil ETFs, and oil futures. It's important to carefully review the fund's investment strategy, fees, and historical performance before investing. Direct investment in oil companies. Another option is to directly invest in oil companies involved in exploration, production, refining, or marketing. This can be done through private equity investments or by participating in initial public offerings, IPOs, of oil companies. Direct investments in oil companies can offer the potential for higher returns but also come with higher risks and may require a larger capital commitment. Master Limited Partnerships (MLPs). MLPs are publicly traded partnerships that are primarily engaged in the transportation, storage, and processing of oil and natural gas. Investing in MLPs can provide exposure to the midstream sector of the oil industry, which involves the infrastructure and logistics of transporting oil and gas. MLPs often offer attractive dividend yields but come with complex tax implications, so it's important to consult with a tax professional before investing. Oil royalties and royalty trusts. Investing in oil royalties or royalty trusts allows you to receive a share of the revenue generated from oil production. Royalty interests are typically acquired by purchasing mineral rights or leasing land to oil companies. Royalty trusts are publicly traded entities that hold royalty interests and distribute income to unit holders. Investing in oil royalties can provide a passive income stream, but it's important to assess the potential risks and rewards associated with specific royalty interests or trusts. Before investing in oil, it's crucial to conduct thorough research, understand the risks involved, and consider your investment goals and risk tolerance. It's also advisable to consult with a financial advisor or investment professional who specializes in the oil industry to get personalized advice based on your individual circumstances. 10.3 Tax Planning Strategies. When it comes to investing in oil, tax planning strategies play a crucial role in maximizing your returns and minimizing your tax liabilities. By understanding the tax implications and utilizing effective tax planning strategies, you can optimize your investment strategy and enhance your overall profitability. In this section, we will explore some key tax planning strategies that can help you navigate the complex world of oil investing. 1. Utilize tax-advantaged accounts. One effective tax planning strategy is to invest in oil through tax-advantaged accounts such as individual retirement accounts, IRAs, or 401k plans. By doing so, you can enjoy certain tax benefits, such as tax-deferred growth or tax-free withdrawals, depending on the type of account. These accounts provide you with the opportunity to invest in oil without incurring immediate tax liabilities on your investment gains. 2. Consider tax-exempt municipal bonds. Investing in tax-exempt municipal bonds can be another tax-efficient strategy for oil investors. Municipal bonds issued by state or local governments often offer tax-free interest income, making them an attractive option for investors seeking tax advantages. By investing in municipal bonds that finance oil-related projects or infrastructure, you can potentially earn tax-free income while supporting the development of the oil industry. 3. Take advantage of capital gains tax rates. Capital gains tax rates can significantly impact your investment returns. By understanding the tax rates applicable to different holding periods, you can strategically plan your investment exits to minimize your tax liabilities. Generally, long-term capital gains, assets held for more than 1 year, are taxed at lower rates compared to short-term capital gains, assets held for 1 year or less. Therefore, if you anticipate a substantial gain from your oil investments, it may be beneficial to hold your positions for more than 1 year to take advantage of the lower long-term capital gains tax rates. 4. Harvest tax losses. Tax loss harvesting is a strategy that involves selling investments that have experienced losses to offset capital gains and potentially reduce your overall tax liability. If you have oil investments that have declined in value, you can strategically sell those positions to generate capital losses. These losses can be used to offset capital gains from other investments, reducing your taxable income. However, it's important to be mindful of the wash sale rule, which prohibits repurchasing the same or substantially identical investment within 30 days of selling it to claim the tax loss. 5. Consider structuring investments as limited partnerships. Investing in oil through limited partnerships can offer certain tax advantages. Limited partnerships allow investors to participate in oil projects while enjoying the benefits of pass-through taxation. In a limited partnership structure, the income, deductions, and credits generated by the partnership flow through to the individual partner's tax returns. This can potentially result in lower tax liabilities compared to investing directly in oil companies or other investment vehicles. 6. Stay informed about tax legislation and incentives. Tax laws and regulations are subject to change, and new incentives or deductions may be introduced that can benefit oil investors. It's essential to stay informed about any updates or changes in tax legislation that may impact your investments. Consulting with a tax professional or financial advisor who specializes in oil investing can help you navigate the ever-evolving tax landscape and identify new opportunities for tax savings. 7. Keep detailed records and receipts. Maintaining accurate and detailed records of your oil investments is crucial for effective tax planning. Keep track of all relevant documents, including purchase and sale records, dividend statements, and any expenses related to your investments. These records will be essential when calculating your gains or losses and determining your tax obligations. Additionally, keeping receipts for expenses such as research materials, investment advisory fees, or travel expenses related to your oil investments can potentially be used as deductions to reduce your taxable income. 8. Consult with a tax professional. Given the complexity of tax planning in the oil investing space, it is highly recommended to consult with a qualified tax professional who specializes in oil investments. A tax professional can provide personalized advice based on your specific circumstances and help you navigate the intricacies of tax planning. They can assist you in optimizing your tax strategy, ensuring compliance with tax laws, and maximizing your tax savings. In conclusion, tax planning strategies are essential for oil investors to optimize their returns and minimize tax liabilities. By utilizing tax-advantaged accounts, considering tax-exempt municipal bonds, Understanding capital gains tax rates, harvesting tax losses, structuring investments as limited partnerships, staying informed about tax legislation, keeping detailed records, and consulting with a tax professional, you can effectively plan your taxes and enhance your overall investment strategy. Remember, tax planning should always be done in consultation with a qualified tax professional to ensure compliance with tax laws and regulations. To invest in oil, there are several options available to you. Here are some common ways to invest in oil. Investing in oil stocks. One of the most popular ways to invest in oil is by purchasing stocks of oil companies. This allows you to indirectly invest in the oil industry and benefit from the performance of these companies. When considering oil stocks, it is important to research and analyze the financial health, management, and future prospects of the companies you are interested in. Investing in oil ETFs. Exchange-traded funds (ETFs) are investment funds that trade on stock exchanges. There are ETFs specifically focused on the oil industry, which allow investors to gain exposure to a diversified portfolio of oil-related assets. Investing in oil ETFs can be a convenient way to invest in the oil sector without having to select individual stocks. Investing in oil futures and options. Futures and options contracts are financial derivatives that allow investors to speculate on the future price of oil. These contracts provide the opportunity to profit from price movements in the oil market without owning the physical commodity. However, trading futures and options can be complex and risky, requiring a good understanding of the market and careful risk management. Investing in oil mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of securities, including oil-related assets. Investing in oil mutual funds can provide exposure to a range of oil companies and other oil-related investments. It is important to carefully review the fund's investment strategy, fees, and historical performance before investing. Investing in oil exploration and production. Another way to invest in oil is by directly investing in companies involved in oil exploration and production. These companies are responsible for finding and extracting oil from the ground. Investing in exploration and production companies can be more volatile and risky compared to investing in larger, more established oil companies. Investing in oil refining and marketing. Oil refining and marketing companies are involved in processing crude oil into refined products and distributing them to consumers. Investing in these companies can provide exposure to the downstream sector of the oil industry. It is important to consider factors such as the company's refining capacity, market share, and ability to adapt to changing market conditions. Investing in oilfield services. Oilfield services companies provide various services and equipment to support oil exploration, production, and refining activities. Investing in these companies can be a way to indirectly participate in the oil industry. It is important to evaluate the company's financial health, customer base, and competitive position within the industry. Investing in oil commodities. Investing directly in oil commodities involves buying and selling physical barrels of oil. This can be done through commodity exchanges or specialized trading platforms. Investing in oil commodities requires a good understanding of the market, supply and demand dynamics, and the ability to manage the logistics of physical delivery or storage. When investing in oil, it is crucial to consider the risks involved. Oil prices can be volatile and subject to various factors such as geopolitical events, economic conditions, and supply and demand dynamics. It is important to conduct thorough research, diversify your investments, and consider consulting with a financial advisor or tax professional to ensure your investment strategy aligns with your financial goals and risk tolerance. Remember, investing in oil carries risks, and it is important to carefully evaluate your investment options and seek professional advice before making any investment decisions. 11. Developing an oil investment strategy. To invest in oil, there are several options available to you. You can invest in oil stocks, oil ETFs, oil futures and options, oil mutual funds, or even directly in oil commodities. Each investment option has its own advantages and risks, so it's important to understand your investment goals and risk tolerance before making any decisions. Before diving into the different investment options, it's crucial to set clear investment goals. Setting investment goals will help you determine the appropriate investment strategy and guide your decision-making process. Here are some key factors to consider when setting your investment goals. Time horizon. Determine how long you are willing to invest your money in the oil market. Are you looking for short-term gains or long-term growth? Your time horizon will influence the type of investments you choose and the level of risk you are comfortable with. Risk tolerance. Assess your risk tolerance level. Are you willing to take on higher risks for potentially higher returns, or do you prefer more conservative investments? Oil investments can be volatile, so it's important to understand and accept the risks involved. Income versus capital appreciation. Decide whether you are primarily seeking income or capital appreciation from your oil investments. Some investments, such as oil stocks, may provide regular dividend payments, while others, like oil futures, may offer the potential for significant capital gains. Portfolio diversification. Consider how oil investments fit into your overall investment portfolio. Diversification is key to managing risk, so it's important to allocate your investments across different asset classes and industries. Environmental and social factors. Determine if you have any specific environmental or social considerations when it comes to your investments. Some investors may prioritize investing in renewable energy or socially responsible companies within the oil industry. Once you have a clear understanding of your investment goals, you can start exploring the different investment options available in the oil market. Here's a brief overview of some common oil investment options. Oil stocks. Investing in oil company stocks allows you to become a partial owner of the company. You can choose to invest in large integrated oil companies or smaller exploration and production companies. It's important to research and analyze the financial health, management, and growth prospects of the companies before investing. Oil ETFs. Exchange-traded funds (ETFs) offer a convenient way to invest in a diversified portfolio of oil-related assets. Oil ETFs can track the performance of oil companies, oil futures contracts, or oil commodity prices. They provide exposure to the oil market without the need to directly invest in individual stocks or commodities. Oil futures and options. Futures and options contracts allow investors to speculate on the future price of oil. These derivative instruments can be highly leveraged and require a good understanding of the oil market and risk management strategies. Oil mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of oil-related securities. They are managed by professional fund managers who make investment decisions on behalf of the investors. Oil mutual funds can provide exposure to a wide range of oil-related investments, including stocks, bonds, and commodities. It's important to note that investing in oil carries certain risks, including price volatility, geopolitical factors, regulatory changes, and environmental concerns. It's advisable to consult with a financial advisor or investment professional who specializes in the oil industry to help you navigate the complexities and make informed investment decisions. Remember, investing in oil should be part of a well-diversified investment portfolio that aligns with your overall financial goals and risk tolerance. Regularly review and adjust your investment strategy as market conditions and your personal circumstances change. To invest in oil, there are several options available to you. Here are some common ways to invest in oil. Investing in oil stocks. One of the most popular ways to invest in oil is by purchasing stocks of oil companies. These companies are involved in various aspects of the oil industry, such as exploration, production, refining, and marketing. By investing in oil stocks, you can participate in the potential growth and profitability of these companies. Investing in oil ETFs. Exchange-traded funds (ETFs) are investment funds that trade on stock exchanges. There are ETFs specifically designed to track the performance of oil-related assets, such as oil futures contracts or oil company stocks. Investing in oil ETFs provides diversification and allows you to gain exposure to the oil industry without directly owning individual stocks. Investing in oil futures and options. Oil futures and options contracts allow investors to speculate on the future price of oil. Futures contracts obligate the buyer to purchase a specified quantity of oil at a predetermined price and date, while options contracts give the buyer the right, but not the obligation, to buy or sell oil at a specific price within a certain time frame. These derivative instruments can be highly volatile and require a good understanding of the oil market. Investing in oil mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of securities, including oil-related assets. Oil mutual funds are managed by professional fund managers who make investment decisions on behalf of the investors. Investing in oil mutual funds can provide exposure to a broad range of oil-related investments, reducing the risk associated with investing in individual stocks. Investing in oil exploration and production. Another way to invest in oil is by directly investing in companies involved in oil exploration and production. These companies are responsible for discovering and extracting oil from the ground. Investing in exploration and production companies can be more volatile than investing in larger, integrated oil companies, but it also offers the potential for higher returns. Investing in oil refining and marketing. Oil refining and marketing companies are involved in processing crude oil into refined products, such as gasoline, diesel, and jet fuel, and distributing them to consumers. Investing in these companies allows you to participate in the downstream segment of the oil industry. Refining and marketing companies can be influenced by factors such as refining margins, demand for refined products, and transportation costs. Investing in oilfield services. Oilfield services companies provide various services to the oil industry, including drilling, well maintenance, and equipment rental. These companies play a crucial role in supporting oil exploration and production activities. Investing in oilfield services companies can provide exposure to the oil industry while diversifying away from direct commodity price risk. Investing in oil commodities. For investors who want direct exposure to the price of oil, investing in oil commodities is an option. This can be done through purchasing physical barrels of oil or investing in oil futures contracts. However, investing in oil commodities requires a good understanding of the market dynamics and the ability to manage the associated risks. When investing in oil, it is important to consider your investment goals, risk tolerance, and time horizon. Diversification is also crucial to manage risk effectively. By spreading your investments across different types of oil-related assets, such as stocks, ETFs, and mutual funds, as well as different segments of the oil industry, you can reduce the impact of any single investment on your overall portfolio. Additionally, staying informed about the latest developments in the oil market and regularly reviewing and adjusting your investment strategy can help you make informed investment decisions. To invest in oil, there are several options available to you. Here are some common ways to invest in oil. Oil stocks. Investing in oil company stocks is one of the most popular ways to gain exposure to the oil industry. You can buy shares of publicly traded oil companies, such as ExxonMobil or Chevron, through a brokerage account. When investing in oil stocks, it's important to research and analyze the financial health, management, and future prospects of the companies you are considering. Oil ETFs. Exchange-traded funds (ETFs) are investment funds that trade on stock exchanges, and they can provide exposure to the oil industry. Oil ETFs typically hold a portfolio of oil-related assets, such as stocks of oil companies, futures contracts, or physical oil. By investing in an oil ETF, you can gain diversified exposure to the oil industry without having to buy individual stocks. Oil futures and options. Futures and options contracts allow investors to speculate on the future price of oil. These derivatives are traded on commodity exchanges and can be highly leveraged, meaning you can control a large amount of oil with a relatively small investment. However, trading futures and options requires a good understanding of the market and can be risky for inexperienced investors. Oil mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of securities, including oil-related assets. By investing in an oil mutual fund, you can gain exposure to a variety of oil companies and other oil-related investments. Mutual funds are managed by professional fund managers who make investment decisions on behalf of the investors. Oil exploration and production companies. Another way to invest in oil is by directly investing in oil exploration and production (E&P) companies. These companies are involved in the discovery and extraction of oil reserves. Investing in E&P companies can be riskier than investing in established oil companies, as there is a higher level of uncertainty and potential for volatility. Oil refining and marketing companies. Investing in oil refining and marketing companies allows you to participate in the downstream activities of the oil industry. These companies process crude oil into refined products, such as gasoline, diesel, and jet fuel, and distribute them to consumers. Investing in refining and marketing companies can provide exposure to the demand side of the oil industry. Oilfield services companies. Oilfield services companies provide various services and equipment to the oil industry, such as drilling, well maintenance, and equipment rental. Investing in these companies can be a way to indirectly participate in the oil industry by supporting the operations of oil exploration and production companies. Oil commodities. Investing in oil commodities involves buying and selling physical barrels of oil. This can be done through commodity exchanges or by purchasing oil through specialized platforms. Investing in oil commodities requires knowledge of the market and the ability to store and transport physical oil. When investing in oil, it's important to consider the risks involved. Oil prices can be volatile and are influenced by various factors, including global supply and demand dynamics, geopolitical events, and economic conditions. It's also crucial to diversify your portfolio and not allocate all your investments to the oil sector alone. By spreading your investments across different asset classes and industries, you can reduce the impact of any single investment on your overall portfolio. Before making any investment decisions, it's advisable to do thorough research, consult with a financial advisor, and consider your own risk tolerance and investment goals. To invest in oil, there are several options available to you. Here are some common ways to invest in oil. Investing in oil stocks. One of the most popular ways to invest in oil is by purchasing stocks of oil companies. This allows you to indirectly invest in the oil industry and benefit from the performance of these companies. When selecting oil stocks, it is important to research and analyze the financial health, management, and growth potential of the companies. Investing in oil ETFs. Exchange-traded funds (ETFs) are investment funds that trade on stock exchanges. Oil ETFs are designed to track the performance of oil-related assets, such as oil company stocks or oil futures contracts. Investing in oil ETFs provides diversification and allows you to gain exposure to the oil industry without directly investing in individual stocks. Investing in oil futures and options. Futures and options contracts allow investors to speculate on the future price of oil. These derivative instruments provide the opportunity to profit from price movements in the oil market. However, trading futures and options can be complex and risky, requiring a deep understanding of the market and careful risk management. Investing in oil mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of securities, including oil-related assets. Investing in oil mutual funds provides exposure to a range of oil companies and can be a convenient way to invest in the oil industry. It is important to carefully evaluate the fund's investment strategy, fees, and historical performance before investing. Investing in oil exploration and production. Another way to invest in oil is by directly investing in oil exploration and production companies. These companies are involved in the discovery, extraction, and production of oil and gas reserves. Investing in exploration and production companies can be more volatile and risky compared to investing in established oil companies, but it also offers the potential for higher returns. Investing in oil refining and marketing. Oil refining and marketing companies are involved in the processing, distribution, and sale of refined oil products. Investing in these companies allows you to participate in the downstream sector of the oil industry. It is important to evaluate the company's refining capacity, market share, and profitability before making investment decisions. Investing in oilfield services. Oilfield services companies provide various services and equipment to support oil exploration, production, and refining activities. Investing in oilfield services companies can be a way to indirectly invest in the oil industry while diversifying your portfolio. It is important to assess the company's contracts, customer base, and competitive advantage before investing. Investing in oil commodities. Investing directly in oil commodities, such as crude oil or refined oil products, is another option. This can be done through futures contracts, options, or exchange-traded products that track the price of oil. Investing in oil commodities requires a good understanding of the market and the ability to manage the risks associated with commodity trading. When investing in oil, it is crucial to monitor and adjust your investment strategy regularly. Here are some key considerations for monitoring and adjusting your strategy. Stay informed. Keep up to date with the latest news and developments in the oil industry. Monitor factors that can impact oil prices, such as geopolitical events, supply and demand dynamics, and regulatory changes. This information will help you make informed decisions about your investments. Review company performance. Regularly review the financial performance and operational updates of the oil companies in your portfolio. Assess their production levels, reserves, profitability, and market share. This will help you identify any underperforming companies or potential investment opportunities. Rebalance your portfolio. Periodically rebalance your portfolio to ensure it remains diversified and aligned with your investment goals. Adjust your holdings based on changes in the oil market and the performance of individual investments. This can help manage risk and optimize returns. Consider risk management strategies. Implement risk management strategies, such as stop-loss orders or trailing stops, to protect your investments from significant losses. These strategies can help limit downside risk and preserve capital in volatile market conditions. Seek professional advice. Consider consulting with a financial advisor or investment professional who specializes in the oil industry. They can provide valuable insights and guidance tailored to your investment objectives and risk tolerance. Stay disciplined. Stick to your investment strategy and avoid making impulsive decisions based on short-term market fluctuations. Maintain a long-term perspective and focus on the fundamentals of the oil industry and your investment goals. By monitoring and adjusting your oil investment strategy, you can adapt to changing market conditions and maximize your chances of success in the oil industry. Remember to conduct thorough research, diversify your portfolio, and stay informed to make informed investment decisions. 12. The future of oil investing. 12.1 Emerging trends in the oil industry. The oil industry is constantly evolving, driven by technological advancements, environmental concerns, and changing global dynamics. As an oil investor, it is crucial to stay informed about the emerging trends that are shaping the industry. By understanding these trends, you can make more informed investment decisions and position yourself for long-term success. Shift towards renewable energy. One of the most significant emerging trends in the oil industry is the increasing focus on renewable energy sources. As the world grapples with the challenges of climate change and the need to reduce greenhouse gas emissions, there is a growing demand for cleaner and more sustainable energy alternatives. This shift towards renewable energy is driven by advancements in technology, government policies, and changing consumer preferences. Investors in the oil industry should be aware of this trend and consider diversifying their portfolios to include renewable energy investments. This can be done by investing in renewable energy companies that are involved in the production of solar, wind, or hydroelectric power. Additionally, there are also opportunities to invest in companies that provide technologies and services to support the renewable energy sector. Digital transformation and automation. Another emerging trend in the oil industry is the increasing adoption of digital technologies and automation. Oil companies are leveraging advanced technologies such as artificial intelligence, big data analytics, and robotics to optimize their operations, improve efficiency, and reduce costs. These technologies enable companies to gather and analyze vast amounts of data, leading to better decision-making and more effective resource management. Investors should pay attention to oil companies that are embracing digital transformation and automation. These companies are likely to have a competitive advantage in the industry and may offer attractive investment opportunities. By investing in companies that are at the forefront of technological advancements, investors can position themselves for long-term growth and profitability. Energy transition and diversification. As the world transitions towards cleaner energy sources, oil companies are also diversifying their portfolios to include other forms of energy. Many oil companies are investing in natural gas, which is considered a cleaner alternative to traditional fossil fuels. Natural gas emits fewer greenhouse gases and is abundant in many parts of the world. Investors can take advantage of this trend by considering investments in natural gas companies. These companies are well positioned to benefit from the increasing demand for natural gas as a transition fuel. Additionally, investing in companies that are involved in the production of liquefied natural gas (LNG) can also be a lucrative opportunity, as LNG is becoming an important part of the global energy mix. Focus on environmental and social responsibility. Environmental and social responsibility have become key considerations for oil companies and investors alike. As the world becomes more conscious of the impact of fossil fuels on the environment and local communities, there is a growing demand for companies that prioritize sustainability and social responsibility. Investors should look for oil companies that have robust environmental and social governance practices. These companies are more likely to be resilient in the face of changing regulations and consumer preferences. Additionally, investing in companies that are actively working towards reducing their carbon footprint and implementing sustainable practices can provide long-term value and mitigate risks associated with environmental concerns. Geopolitical and economic factors. Geopolitical and economic factors continue to play a significant role in the oil industry. Political instability, conflicts, and trade disputes can have a profound impact on oil prices and market dynamics. Investors should closely monitor geopolitical developments and assess their potential impact on oil markets. Additionally, economic factors such as global economic growth, inflation, and interest rates can also influence oil prices. Understanding these factors and their interplay with the oil industry is crucial for making informed investment decisions. By staying informed about geopolitical and economic trends, investors can better navigate the volatility of the oil market and identify investment opportunities. In conclusion, the oil industry is undergoing significant changes driven by emerging trends such as the shift towards renewable energy, digital transformation, energy transition, and a focus on environmental and social responsibility. By staying informed about these trends and their implications, oil investors can position themselves for long-term success. It is important to conduct thorough research, diversify portfolios, and stay updated on the latest developments in the industry to make informed investment decisions. 12.2 Technological advancements in oil extraction. Technological advancements have played a significant role in the oil industry, revolutionizing the way oil is extracted and increasing efficiency in the process. These advancements have not only improved the profitability of oil investments but have also addressed environmental concerns and sustainability issues. In this section, we will explore some of the key technological advancements in oil extraction and their impact on the future of oil investing. Enhanced Oil Recovery (EOR). Enhanced oil recovery (EOR) techniques have been developed to extract oil from reservoirs that cannot be recovered using conventional methods. EOR involves injecting various substances into the reservoir to increase the flow of oil. One commonly used technique is water flooding, where water is injected into the reservoir to displace the oil and push it towards the production wells. Other EOR methods include gas injection, carbon dioxide or natural gas, and chemical injection, polymer or surfactant. EOR techniques have significantly increased the recovery rates of oil fields, allowing investors to tap into previously untapped reserves. This has opened up new investment opportunities in mature oil fields that were once considered depleted. Horizontal drilling. Horizontal drilling is a technique that involves drilling a wellbore horizontally through the reservoir rock, allowing for greater access to the oil-bearing formations. This technique has revolutionized the oil industry by increasing the contact area between the wellbore and the reservoir, resulting in higher production rates. Horizontal drilling has been particularly successful in shale oil and tight oil formations, where the oil is trapped in low permeability rock. By drilling horizontally through these formations, oil companies can access previously uneconomical reserves. This has led to a boom in shale oil production, particularly in regions like the Permian Basin in the United States. For investors, horizontal drilling has opened up new investment opportunities in unconventional oil plays, providing access to previously inaccessible reserves and potentially higher returns. Hydraulic fracturing, fracking. Hydraulic fracturing, commonly known as fracking, is a technique used to extract oil and gas from shale formations. It involves injecting a mixture of water, sand, and chemicals into the wellbore at high pressure, creating fractures in the rock and allowing the oil and gas to flow more freely. Fracking has revolutionized the oil industry by unlocking vast reserves of shale oil and gas. This has not only increased oil production but has also reduced dependence on imported oil in some countries. For investors, fracking has created new investment opportunities in shale oil and gas companies, particularly in regions with significant shale resources. However, it is important to note that fracking has also raised environmental concerns due to potential water contamination and seismic activity. As a result, there has been increased scrutiny and regulation of fracking operations in many jurisdictions. Digitalization and automation. Digitalization and automation have transformed the oil industry by improving operational efficiency and reducing costs. Advanced sensors, data analytics, and artificial intelligence (AI) technologies are being used to optimize drilling operations, monitor equipment performance, and predict maintenance needs. By leveraging real-time data and analytics, oil companies can make more informed decisions, optimize production, and reduce downtime. This not only improves profitability but also reduces the environmental footprint of oil operations by minimizing waste and emissions. For investors, digitalization and automation present opportunities to invest in technology companies that provide innovative solutions to the oil industry. These companies are at the forefront of developing cutting-edge technologies that improve efficiency and sustainability in oil extraction. Conclusion. Technological advancements in oil extraction have transformed the oil industry, creating new investment opportunities and addressing environmental concerns. Enhanced oil recovery (EOR), horizontal drilling, hydraulic fracturing, fracking, and digitalization have revolutionized the way oil is extracted, increasing production rates and accessing previously untapped reserves. As an investor, it is important to stay informed about these technological advancements and their impact on the oil industry. By understanding the potential risks and rewards associated with these advancements, you can make informed investment decisions and position yourself for success in the ever-evolving world of oil investing. 12.3 Environmental and Sustainability Considerations. As the world becomes more conscious of the environmental impact of fossil fuels, environmental and sustainability considerations have become increasingly important in the oil industry. Investors in oil must now take into account the potential risks and opportunities associated with environmental factors and sustainability practices. This section will explore the key considerations for investors when it comes to the environment and sustainability in oil investing. Environmental impact of oil. One of the primary concerns surrounding oil investing is the environmental impact of oil extraction, production, and consumption. The extraction of oil can have significant environmental consequences, including habitat destruction, water pollution, and greenhouse gas emissions. Additionally, the burning of fossil fuels, including oil, is a major contributor to climate change. Investors need to be aware of the environmental impact of the oil companies they invest in. This includes evaluating their environmental policies and practices, such as their efforts to reduce emissions, minimize waste, and promote sustainable practices. Companies that prioritize environmental stewardship and invest in renewable energy technologies may be more attractive to environmentally conscious investors. Sustainability practices in the oil industry. Sustainability practices in the oil industry involve minimizing the negative impacts of oil extraction and production while maximizing the efficient use of resources. This includes implementing technologies and practices that reduce emissions, conserve water, and promote energy efficiency. Investors should consider the sustainability practices of oil companies when making investment decisions. Companies that prioritize sustainability may be better positioned to adapt to changing regulations and consumer preferences. They may also be more resilient in the face of potential environmental risks and have a competitive advantage in the evolving energy landscape. Regulatory and policy considerations. Regulatory and policy considerations play a significant role in shaping the environmental and sustainability landscape for oil investing. Governments around the world are implementing stricter regulations and policies to reduce greenhouse gas emissions and promote renewable energy sources. These regulations can impact the profitability and viability of oil investments. Investors should stay informed about the regulatory and policy developments in the countries where they plan to invest in oil. This includes understanding the potential impact of carbon pricing mechanisms, renewable energy targets, and emissions reduction policies. By considering these factors, investors can better assess the long-term viability and profitability of their oil investments. Transition to renewable energy. The transition to renewable energy sources is a significant trend that investors in the oil industry must consider. As the world seeks to reduce its reliance on fossil fuels, renewable energy technologies such as solar, wind, and hydroelectric power are gaining momentum. This transition presents both risks and opportunities for oil investors. Investors should evaluate the potential impact of the transition to renewable energy on their oil investments. This includes assessing the long-term demand for oil and the potential for stranded assets. Companies that are diversifying their energy portfolios and investing in renewable energy technologies may be better positioned to navigate this transition. Social responsibility and reputation. In addition to environmental and sustainability considerations, investors should also consider the social responsibility and reputation of the oil companies they invest in. Public perception and reputation can have a significant impact on the success and profitability of oil investments. Investors should assess the social responsibility practices of oil companies, including their community engagement, labor practices, and commitment to corporate social responsibility. Companies that prioritize social responsibility and have a positive reputation may be more resilient in the face of environmental and social challenges. Conclusion. Environmental and sustainability considerations are becoming increasingly important in the oil industry. Investors in oil must now take into account the potential risks and opportunities associated with environmental factors and sustainability practices. By evaluating the environmental impact of oil, considering sustainability practices, staying informed about regulatory and policy developments, assessing the transition to renewable energy, and considering social responsibility and reputation, investors can make more informed decisions and navigate the evolving landscape of oil investing. 12.4 Long-term outlook for oil investing. Investing in oil has long been a popular choice for investors looking to diversify their portfolios and potentially earn significant returns. However, as the world continues to shift towards renewable energy sources and environmental concerns become more prominent, it is important to consider the long-term outlook for oil investing. The transition to renewable energy. One of the key factors shaping the future of oil investing is the global transition to renewable energy sources. As governments and organizations around the world prioritize reducing carbon emissions and combating climate change, there is a growing shift towards cleaner and more sustainable energy alternatives. This transition presents both challenges and opportunities for oil investors. On one hand, the demand for oil may decrease as renewable energy sources become more prevalent. This could lead to a decline in oil prices and potentially impact the profitability of oil investments. On the other hand, the demand for oil is expected to remain strong in the near future, especially in developing countries where energy consumption is rapidly increasing. Additionally, oil companies are also diversifying their portfolios and investing in renewable energy projects to adapt to the changing landscape. This presents an opportunity for investors to explore a hybrid approach by investing in both traditional oil companies and renewable energy companies. Geopolitical factors. Geopolitical factors have always played a significant role in the oil industry, and they will continue to shape the long-term outlook for oil investing. Political instability, conflicts, and sanctions can disrupt oil production and supply, leading to price volatility and potential investment risks. Investors need to closely monitor geopolitical developments and assess the potential impact on oil prices and investments. Understanding the political landscape of major oil-producing regions, such as the Middle East, Russia, and Venezuela, is crucial for making informed investment decisions. Technological advancements. Technological advancements in oil extraction and production have the potential to impact the long-term outlook for oil investing. Innovations such as hydraulic fracturing, fracking, and horizontal drilling have unlocked previously inaccessible oil reserves, leading to increased production and changing the dynamics of the global oil market. These technological advancements have not only increased oil supply but also reduced production costs, making certain oil investments more attractive. However, it is important to note that technological advancements in renewable energy sources may also disrupt the oil industry in the long run. Investors should stay informed about the latest technological developments in the oil industry and assess their potential impact on oil prices and investment opportunities. Environmental and sustainability considerations. Environmental and sustainability considerations are becoming increasingly important in the investment landscape. As the world becomes more conscious of the environmental impact of fossil fuels, investors are seeking opportunities that align with their values and support a sustainable future. Investing in companies that prioritize environmental stewardship and are actively working towards reducing their carbon footprint can be a way to navigate the changing landscape of oil investing. This includes companies that invest in renewable energy projects, implement sustainable practices, and prioritize environmental, social, and governance (ESG) factors. Diversification and risk management. As with any investment, diversification and risk management are crucial when investing in oil. While the long-term outlook for oil investing may present opportunities, it is important to balance oil investments with other asset classes to mitigate risk. Diversifying your portfolio across different sectors, industries, and geographies can help reduce the impact of any potential downturns in the oil market. This includes considering investments in renewable energy, other commodities, stocks, bonds, and real estate. Additionally, staying informed about market trends, conducting thorough research, and regularly reviewing and adjusting your investment strategy can help manage risks and maximize potential returns. Conclusion. The long-term outlook for oil investing is influenced by various factors, including the transition to renewable energy, geopolitical considerations, technological advancements, and environmental concerns. While the future of oil investing may face challenges, there are still opportunities for investors who carefully analyze market trends, diversify their portfolios, and stay informed about the changing dynamics of the oil industry. As with any investment, it is important to conduct thorough research, seek professional advice, and regularly review and adjust your investment strategy to navigate the evolving landscape of oil investing. By staying informed and proactive, investors can position themselves to make informed decisions and potentially benefit from the opportunities that arise in the oil market.